Well, good morning, folks. Long time no see. How's everybody doing? I'm checking Twitter. I prompted those that follow me on Twitter to give me a 5x5 if the chart and my audio is good and if the volume's good for you. Let me know. As soon as I get a 5x5 from any of you, I'll know I'm good to go. Thank you, folks. Thank you. All right, so I may require I gotta be careful here. It looks like the volume is a little too loud, goes into the red. So I'll have to talk like I normally do. So it should be fine. Anyway, we have a few things that we're going to cover this morning. And if it is your first time here watching a live stream from me, usually when I do a live stream, I'll go in, I'll look at live price action, and depending upon how I deliver, how long I go this morning, I don't think I have a whole lot of time for the teaching part of it and the review. It'll just depend on what we do at the opening, and we'll see if we can look at some live price action. No promises, but we'll see what we see. It's important for you to keep up with the ICT Mentorship 2023 playlist. So anything that I put up, whether it be a live stream like this or another lecture, I add it to the 2023 Mentorship playlist on my YouTube channel. If you're new, okay, and I'll get this out of the way here, some short housekeeping. If you're brand new to my channel and you want to know where to go in and start, my advice is to go into the 2022 ICT Mentorship playlist. It's 41 videos. The first video, you really don't need to watch that one, but for completeness sake, to say you watched it, the first one kind of like sets the tone for what you're trying to or should be expecting. If you have never seen anything from my content, if you really don't know how to read price action, and you really just want to get down to the brass tacks, because I am long-winded, because I want to give you value, and if I'm going to teach something, I want to get the highest form of understanding communicated to those individuals that want to learn. If you're short attention span, or if you are not really interested in knowing everything about why you would be incurring risk or taking on risk, if anything less than that, then you're really setting yourself up for failure. So if a teacher or an educator is making themselves available, it's important that their passion is behind that education, because your results are a direct reflection on my ability to communicate the logic. And I want to convey as much detail as possible, instead of just saying, this is what a buy signal looks like, this is what a sell signal looks like, and then give you a static screenshot of this is what it looks like all the time. It doesn't look like that all the time. There's like subtle little variances in the way price action is delivered. And it's important for you, especially for someone that's new, okay, or if you only refer to price action through a retail perspective. And when I say we don't trade retail or we don't follow retail logic, we're not looking at the things that permeates this industry, which is collective in all the books, courses, and regurgitated. So that's what makes my content sometimes a little overwhelming or overcomplicated, because you're trying to form fit the things that you think you know into what it is I'm teaching. And my challenge has always been, don't believe what I said or say about it. Go into your charts and see if what it is I'm saying is there or not. I'm confident if you do the due diligence to do that, you will find it. Okay, so if you're new and you want to, like a study program, I tweeted this the other day on my Twitter account, but the best, shortest cut, right to the point, pardon me, is the 2022 playlist. That is a model that I designed for my daughter. My heart went into it. I wanted to make it streamlined. I wanted to present something that was time-based. That way it removes a lot of the when does it form? When would I look for a setup? And I don't know what session to trade. I don't know, should I trade London? Should I trade New York? That pattern of looking for that run on liquidity, a shift in market structure, and then going into the fair value gap, that can be traded in Forex. It can be traded in futures contracts, index futures, currency futures. I have students, I don't trade crypto, but I have students that swear by their results being in crypto. I don't trade synthetic things. Okay, so I know I get a lot of questions from the folks in Africa. I don't trade the volatility index. Okay, so I don't do anything crypto. But that model is something that you can go right into the marketplace and start studying and seeing it, and watching other students when they share their examples and or results with me on Twitter. Many times you're seeing that very model form, and that model is, in my opinion, and I may be incorrect in this, but I'm assuming a great deal here, and give me the liberty to do this because I'm going by what I'm seeing in feedback. A lot of the funded companies are coming forward and basically stating that the majority of their profitable payouts are coming from my student base. So that's a testimony in itself. What are they using? What was the thing that bridged that gap between not really knowing what they're doing and going in and finding money, finding profitability, finding consistency? I believe, and the ones I've interviewed and ones that reached out to me, it's the 2022 model. And I have charter members that have paid me to learn one-on-one, not in the sense that they're sitting right next to me, but this is what I did with them every day. I would sit down, I'd go through the charts, and I'd explain to them what they would expect to see in the price action. And I'm in the high 90% of accuracy. And it's been like that for years in the witness of thousands of people. Now there's hundreds of thousands of people that are publicly watching this stuff happen. And that model can be used on intraday charts. It could be used on higher time frame charts. And I've been beat up lately with a lot of requests for coming off of the lower intraday charts. A lot of you don't want to trade or can't trade those 1 and 5 minute charts. I understand that. But I also include, and as I'm including it right here, that same approach to using those shorter time frame charts. The only reason why I'm doing that is because it affords me lots of examples so that we can see there's consistency, and using the logic, you can find continuity in your analysis, and therefore results could be expected to pretty much be, routine or business-like. If you go to your job, you're not changing what you're doing every single day. You're doing the same monotonous tasks all the time. And as a trader, that's what you're trying to do. You want it to be boring and monotonous. And the best way I could communicate it was that 2022 model. I couldn't make another model simpler than that. And it's working. It's working in the hands of other people. And even for people that just started following me last year, they got funded and they're getting payouts and they're doing well. Some of them are trading their actual live money. In my personal opinion, and this is my personal opinion, this is not to discourage any of you, I don't think you should be trading in your first year. There's a lot of things you're going to learn about yourself. And there's a lot of things about price action that you have to learn as well. But that can't be appreciated if you just go and watch a couple videos and then say, well, let me see if it works with my account, and then risk real money or risk, not being successful with a combine or a challenge from a funded, prop firm or whatever. So just go slow. I promise you, the folks that are doing very well, they put a lot of work into this before they did it. And I'm talking about the 6-figure earners. The guy just did $300,000 in 3 months. Another guy, Jade, he's killing $500,000. Okay, folks, this isn't Mickey Mouse money. Okay, that's real money. It's not demo. These guys are killing it. Paladin, killing it. I have lots of other people that are getting ready to come forward as well that are just smashing it in their own accounts, not doing prop funded accounts. Take your time. Nothing's going to change, okay? The algorithms are going to change. They're not going to turn it around because ICT has told too many people about it. The markets have always booked like this. And the only thing that's going to change in the future is it's going to be much more efficient. So it'll be less of the choppy consolidation because there'll be a lot more people involved. Therefore, the liquidity increases. So it's not a disadvantage to you or a reason for you to be concerned about more people growing in our community using my content. It's literally going to make more liquidity for efficiency, we're not going to be the buy, stop, read, then reversal. We capitalize on that retail mindset. My approach to trading and teaching you is that we harvest liquidity. We hunt it. It's prey. Retail logic, things like moving average crossovers and things like that, there's a place for that. It does make money. You can make money flipping a quarter, but predominantly there is a large degree of, well, neophytes that enter the marketplace. And when I first started, and I promise this is the end, we're getting into the teaching, but it's important for you to know where we're going and where you should be in your expectations and learning. But retail-minded traders think that every single time a overbought, oversold oscillator goes oversold, therefore the market should go up, and that's not true. And I learned that lesson hard in my first year first year and a half. I was insisting upon buying oversold conditions all the time, and I didn't understand bear markets. So it can stay oversold for a long time, and you could be buying falling daggers, and it's very painful trying to catch that. And what I have done in my career is try to communicate things that you wouldn't really learn from anyone else and make it into a language that way it's communicated through charts when the things that make these price moves run are not actually in charts. And that sounds like it's an impossible thing. There are things that are occurring outside of the kill zones I talk about. There are trades that occur, but I could never bridge the gap between what I know about what's going on, therefore finding in a chart that is repeating all the time or enough times to make a setup for it. So the things I teach you, like specific PD arrays, a multiplier, when you're looking for a setup, you're looking for, what is your multiplier? Your multiplier is the thing that you use to get in. That's not a model. Okay, it's the multiplier that puts you in a trade, whether it be my order block, whether it be a fair value gap, inversion, or standard. If it's a institutional order flow entry drill, an optimal trade entry, okay, a propulsion block. All these things are specific multipliers, the things that you're looking for in price action. I teach you, I think it's in month 4 of the core content, and forgive me if I'm not being accurate, but I think it's where it is, month 4, where I go through the PD array matrix. Those are, in my opinion, they're the ones that is the easiest for me to communicate using a time-based chart. Now, I have other PD arrays that are not requiring a chart. Like, I don't need a chart, but that's so complicated. And some of you complain about what I've already taught as being complicated. I'm not even going to touch that. Like, I don't need to have a chart. I could be driving around in my Corvette, know that at this time, between these 3 minutes, I know it's going to do this. And then I know it's going to go this. And I know that. That's algorithmic. But you're here to learn how to do something that repeats over and over again, that you can visually see, that you can trust. And that 2022 model, I promise you, if you study that and spend time with it, in between your practice sessions and back testing, that means going back and looking at chart moves that have happened, it builds this experience base that you require to lean on. I have had a lot of requests for longer term swing trades. So I teach in the core content quarterly shifts. That means like every 2 to 3 months, there is a major intermediate term price swing that takes place on the daily and weekly charts. That is like a macro perspective. So when you sit down, like right now, I'm sitting down for the first time, being away from the charts for a few days. I did some day trading on Friday. I might share some of that with you when we get into ES. But I teach in the Twitter spaces that I do, and also in all the things that I'm rambling about usually in these videos or presentations. If you feel like I am not getting to the point is I'm teaching you how you're going to have to navigate these things. And one of the things I talk about in the realm of psychology is if you're under a lot of stress, not feeling well, had a loss in your family or whatever, it's important not to trade. It's important to stay away from the charts, because you're going to be hurting. And that pain, that discomfort, that boredom can even, spur it on. You're going to do something impulsively. So, I've been going through something emotionally with a pet. So I can't focus. So that's why I've spent some time away. She's improving, thank you. But I can't focus when it's like that. And some of you communicate that same type of thing in other facets of your life in Twitter. You're going through a breakup. You've been sick. You just got fired, and then you're wondering why you're not seeing success or consistency in your trading because you're emotionally charged. So even though my concepts, I believe, are superior, you as the operator, me as the operator, I'm the author of this stuff. And if I am sitting in front of the charts and I'm in a state of mind that is unstable, I'm hurting, I'm emotionally charged, I'm sick, or I'm fatigued if I haven't slept in 2 days. It's usually when I need a nap. And sometimes that happens a lot. So whatever those things are, it's going to be for you that as a barrier or a distraction. Or if you feel an overwhelming desire to want to trade because you feel like you need something to make you feel good or get a high off of it, don't consider my concepts as the silver bullet, quote unquote, to fix that for you. Because you can fail even with these high-end, high-precision elements that I'm teaching you. You as the operator will fail yourself. Just like I would have failed myself if I would have pushed last week and did things that I know I wasn't going to be focusing on. It doesn't mean that the logic is flawed. It doesn't mean that your ability to trade is expired. It just means that you are not firing on all cylinders. That means you're not focused. And you're going to be impulsive. You're going to be reactive. Okay, we don't react to price. We anticipate it. But if you go into the charts with a need to be right, a need to feel better, to feel like you are not worthless because maybe someone broke up with you, those things will channel into, and you'll actually see a setup because you want it to be there versus it being there. So just be mindful that when I'm teaching you, that you have a great deal of responsibility. You have that responsibility, and your success is solely yours. But your failures, you have to own them too. I don't co-sign for either one of them. So with all that preamble and monologue out of the way, let's get into it. I mentioned the last few times we were doing market reviews and analysis, I talked about how let me go over my chart and talking to you with the YouTube studio. It's not going to help me. There we are. So this is the dollar index, and it's shown on a weekly chart. So I mentioned that we would likely reach up into, and we wanted to see it get up into the halfway point of this last up close candle prior to this rotation lower. So this up candle over here, the initial draw was that order block's opening price. That's what's being denoted here. We saw it expand up from that. I told you that this gap here, I wanted to see that treated as an inversion gap, okay, or inversion fair value gap. That's what the IFVG stands for. Now, this is the problem that will arise if you're watching someone that is trying to teach my concepts when they're not even fully taught yet. They would see this gap here, and it runs up, and they'll think, okay, that's a short, because look at these relative equal lows down here. No. There's a logic that has to be applied to it, and a narrative. The fact that we have unfinished business in this order block, there is uncertainty. There's a lot of, there was concern about the U.S. debt ceiling, a potential default, the WAR scenario on the other side of the world. Okay, all these things are causing concern, and that concern is a catalyst for flight to quality or a safe haven. And at the time, at the present, the dollar is still considered that, but I think it's waning. Nonetheless, that sends typically the dollar higher and foreign currencies lower. And we're going to talk about Forex tonight too, or today, and not just ES. But I started with the dollar index because the dollar gives me that risk on, risk off scenario. Now, if I believe that the dollar is likely to go higher, I need to know where it's going to likely draw to. I just can't just indiscriminately go out there and think, well, it's going to go up. Let's just see where it goes. Let's just find out. Okay, that to me is myopic. You need to have a specific level, not a zone. Okay, and not a supply or demand zone. There's specific levels that I'm teaching. This last up close candle right here has the low, the opening price, and the mean threshold, which is the halfway point from high to low. That's what those levels are. The last time we talked, I said we would like to see it get up into, and I said we'll see if it wants to get up to the mean threshold of that order block right there. Nothing said we're going short on dollar. I didn't say we're shorting anything in dollar. We were looking for lower prices on euro dollar, and we'll cover euro dollar when we get at the dollar. So in fact, we saw price run up into it last week, and now here we are on the present week. This is this present current weekly candlestick for the dollar index. Did this gap over here act as support? Yes. Intra week, it did it on this week, but then last week it did it as well. Traded down into it, and now we're trading here. So when we get a lower time frame daily chart, this will be more impactful too. But whenever I give analysis out, whether it be through a tweet or in video, invariably there's this sect of my followers that will say, okay, now what's going to happen? When you should be thinking about what you just watched, and have you broke it down yourself? Have you spent any time in the lower time frames, individual sessions, individual days, over the scope of each individual weekly candle, and see where the setups form with the 2022 model? Because that's what you're supposed to be doing. If you're just waiting for me to put up a new video or talk about something on Twitter, you're really doing yourself a disservice, because a lot of the work, 90% of the work for you succeeding, is done by you. It isn't just by listening to me. Because if it was that easy, everybody that watches my videos would be funded, making money, quitting their jobs, and be rich, and where's all the yachts, right? They don't do the work. And that's why it's offensive sometimes when I tell people, you're not putting in the work. Because what you think the work is many times insignificant. It's not enough. And you have to put real time into it. And what you're doing in that time is spending it in old moves, using the logic and the experience I've shared. I told you that I was wanting the dollar to go higher. That was, go back and listen to the commentaries. It's there. It's not ambiguous. But because I state my opinion, there's a lot more of you publicly that are following me. You sometimes are waited on bated breath just to hear me say something, and you take that and you go out there and you bet real money with it. And that's why I said, don't bet the farm on it. I'm constantly reminding you there's risk. And if you don't know what you're doing, don't be deceived in thinking you think you know what you're doing simply because you watched a few of my videos. It takes time to learn this, and you have to give yourself the time and patience that's needed to do it. So we did in fact see the inversion fair value gap form here, and we're rotated up into daily bearish order block. This right here will be much more easier to see and understand now when we go into a daily chart. Okay, so here's that daily candle. So it looks just like that weekly candle. We have this big old run up here like that. It does not, folks, listen, okay? It does not need to be an engulfing candle. That does not make an order block. Okay, there's so many people out there typing that stuff up in pseudo mentorships things, and like that's not my order block. Okay, the idea of the market rotating after hitting a key level, you take it right to the last candle. That candle does not need to be engulfing anything. That narrative, that's the thing that's missing from these 20-year-olds that run around thinking they know how to do this stuff. And I'm talking to you because I know you're listening. Okay, I'm telling you these things so that way you can improve and not hurt the people that you're trying to fleece. I'm being more responsible with your students than you are. So here's the bearish order block, the opening price. Now, why am I using the opening price versus the low? Whenever there is a short little stubby tail or wick, okay, whenever it's like that, I generally, as a rule of thumb, but not always, but generally, most of the time, I'm going to go right to the opening price. And the reason why I'm doing that, okay, and this is where you write things down, folks. This small little tail on the candle, I know that there's probably something in that lower time frame that I'll be able to use, even if it wants to go outside the realm of the opening price. So I may be able to look at something that may or may not be supportive for a trade in that range. But for a anchoring on a higher time frame basis, I'm anchoring it to the opening price. Now let's assume for a moment that it was a longer tail. In other words, this little segment down here on the candle, say that was longer and the opening was actually somewhere up here. Then I would use the low. And I would use the consequent encroachment of that tail or halfway point of that little wick. So those are the two key levels I would use for a candlestick that has a longer wick. Okay, so there's a little bit more insight about order blocks. And I'm telling you why I'm using the opening price versus the lower high. So have that in your notes and go through your studies, and you'll see that that's a very good general rule to help you. Okay, there will be instances where it does other things. Okay, but I'm not done teaching. But just grow in what I'm sharing now. I'm giving it to you. So we have the weekly order block. We traded up and through it. Hit the daily bearish order block. We traded up into that. Now look at the bodies of these candles. Weekly order block, daily order block. Look at all that encapsulation and price action. The volume of all that trading, the majority of it's being shown in the candlestick bodies. Yes, it expanded, as we would like to see anyway. We're expecting it to go higher. It went above these levels. We don't expect it to stop dead in its tracks when we're bullish. We really want to see it go to it and through it, because the narrative, the expectation we had was the dollar should go higher. And notice that all of the sustained price runs was on the buy side delivery. That means candlesticks that are going up. Infrequent were the down close candles. These are daily candlesticks, by the way. But look how it opened here, traded away from it. Opened, rallied up here, and then traded down. We expanded through and fell short of the main threshold of the weekly order block. And it's important that you annotate your levels. Now I'm showing you how I do this here, and some of you ask all the time, how am I doing that? On TradingView, this is what I have it set up as: middle, center, for it to appear here. And when I'm doing the new week opening gaps, it would just show on the right. So it shows over here. And you'll see the new week opening gap when we get into ES. So we're seeing it dig into these levels, expanding up, reaching, and then finally, once it pierced the mean threshold of the weekly order block at 104.540, then we had a rotation lower. Where did it go back to? That weekly inversion gap, the fair value gap that we anticipated seeing it act as what? Support. Folks, that's narrative. That's not picking both sides of the marketplace. If I'm telling you a specific PD array, that level on that PD array, if it's a range like a fair value gap, it's the high, consequent encroachment, which is the midpoint, and then the low of it. That's not a zone where it's ambiguous. Like, where do you trade a supply and demand zone? Okay, that's why I'm not supply and demand. And I also cut through candles. Supply and demand would not use this level over here based on anything like that, because they say we don't cut through candles. They need a fresh zone. Everything from ICT is fresh, baby. Everything. There's nothing stale here. We always have fresh bread, and my students are always making fresh bread. They do it on their own. They don't ever run out of yeast. Just like this mentor talking to you, I don't ever run out of yeast. You're never going to run out of opportunities. It's never going to happen. There's no reason for you to rush it, because once you get it, nobody can take it from you. Nobody can say you can't do it because they don't like you. They don't like your personality, whatever. You can find these setups. Once you have the understanding, you can go into any market, any time frame, and murder it. Literally murder it. But you're trying to be too quick to assume that everything that you already know will complement what I'm teaching you. No. No, 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 no. What I'm teaching you will make the stuff you tried to be profitable with profitable. If you include the things I'm teaching, how to read price, the draw and liquidity, that's the first lesson. The first lesson I start to drive home in a student's mind is, where's the price trying to gravitate to? Where's it trying to get to? Well, initially I started with the order block, the weekly, then the daily, and the mean threshold of that weekly order block. Does your chart show this? Because you're looking at a live chart right now with me in the live stream. Did it pan out like I showed? Absolutely it did. The same direction I was looking for. Everything I was looking for in terms of the specific levels, I gave you the logic. I talked about it beforehand. It's here now. So it wasn't done with a 1 minute chart. It wasn't traded or worked with in a second chart, sub 1 minute time frame. It wasn't even an hourly chart. I used weekly charts. It works, folks. You can make this work for you. Where you are at in your life, school, business, job, your relationship causes constraints that you can't do the intraday charts. I get it. But don't think that it's a one-trick pony that only works on a 1 minute chart. There's a lot of 1 minute setups that allow me to teach you that there's no short supply of setups. You will always find setups. But there's going to be times when the market will be, well, look at all this mess in here. I don't like these types of periods. I don't like that. And that's why you see me do what? I took time away. I did road trips. Now looking at the price action in hindsight, now it makes perfect sense to you why I was doing what I was doing, right? But at the time you're thinking, oh, they changed the algorithm. ICT's on the run. No, I'm relaxing because I know that all I need to do is see a shift in market structure. What was that? See this high? It breaks it. What does it leave? Fair value gap. See that? Now, we're going to talk about gaps today. My personal private students and the public students, all of you, probably majority of you here, are constantly asking this question. Can you talk about the breakaway gaps? Can you talk about when fair value gaps should not fill? I'm going to teach you about that today. Okay. So if we're looking for a draw on liquidity and we are in this vicinity right here, the first thing we want to draw our attention to was this imbalance here, that shaded area. Now, when I'm showing it to you on a daily chart, and that's the time frame this is being shown in right now for the dollar index, I promise you all of this works in ES. It works in Forex, because I'm starting this whole presentation. This is going to be Forex in the beginning, and then I'll end the discussion in today's live stream on the index futures. But everything I'm teaching you here is applicable to Forex and futures and commodities and gold and bonds. We're going to talk about bonds today too. Okay. But all of this higher time frame gives you, in my opinion, you're welcome to disagree. You're never going to convince me otherwise, but the higher time frames is where the majority of your time should be spent, because it's so easy to get lost on these lower time frame charts, especially if you're new, because you'll think you see all kinds of stuff. The Three Stooges pattern, there isn't one, but I'm just making a joke about how everything can be applied to any time frame. If you want it to be there, you'll see it. It's like a mirage. You're thirsty. You want to get that new drink of success. And just like sometimes in a desert, you'll think you see something out there. It looks like water, and you get up on it. It's just more sand. And you don't want to fill your well with sand by chasing setups that are not there. They're phantoms. Higher time frame removes most of that. Not all of it, removes most of it. So now let's talk about, and again, before I get into any discussion, I want to take you back to the weekly chart and show you what this is again, this shaded area right here. Real quickly. I like to be complete, folks. I don't like to leave anything up for debate. That little section between this candle here, that low, and this candle's high. And the reason why I'm drawing attention to that is, let me take this away just for a second. Can you see how this candle dropped, stopped? The next candle here opened, traded down all the way here, and came back and stopped. The next week it opened, traded up a little bit, but didn't come back all the way to that candle's low. See that? So there's a distinct gap, separation between those two key levels there. And then we expand lower, and we open, trade up, leaving this little portion of price action between this candle's low and this candle's high remained open. Okay, so it's only dropped down. So that's sell side delivery. What is it? Inefficient. Buy side. So it's a SIBI. Sell side inefficiency, buy side. Oh, I said that wrong. Sell side imbalance, buy side inefficiency, SIBI. That little distinct gap there stands out. If we were standing over here on the right of all this price action, look how fortified all these back and forth movements are here. All these candles moving back between over and over again inside of this range here. You see how that is back and forth, back and forth, back and forth, back and forth. That is not inefficient at all. That's a lot of back and forth delivery. In other words, think of the analogy I many times use, like a paint being applied with a roller on a wall. In this area, paint has been distributed back and forth, and paint in this analogy would be price. So the range of offering liquidity up and down in that shaded area, there's no inefficiency whatsoever on this time frame. So where does the inefficiency exist? Right there. It only has one roll down, never up until we get over to here. Okay, so that fair value gap there was the draw up, and the context was I want to see it trade up through it and come down and act as support, and that would make it an inversion fair value gap. If I didn't hold that expectation, it would be treated as a standard fair value gap in a premium relative to the high and the low here. That would be a premium fair value gap, and the way you know that is you take the fib anchored on a high down to the low. Here's equilibrium, and the fair value gap exists right there. At equilibrium or above is premium. At equilibrium or below is discount. But I did not say we're looking for lower prices when it got to this fair value gap. I said we want to see it go to it, through it, and come back down and treat it as support. That's an inversion fair value gap. Don't take my word for it here. Go back and look at the other reviews that I've showed here. Go and look at the tweets. Listen to the Twitter spaces. Sometimes I cuss there. Just be mindful that it's live. Here I try to I tend to do a better job because I'm looking at candlesticks, but if I don't have a candlestick chart in front of me on Twitter Spaces, I generally use blue collar language, and my imbalances inside me just make me not the best mentor for that. But that little gap here is this segment. When we go down to the lower time frame daily chart, now you know what you're looking at. Right there. See, it doesn't look like a gap here because look what it's done. It passes back and forth, okay? Do not assume, this is really important, do not assume that a inefficiency, whether it be a fair value gap that's a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency. Either or. Don't assume if it's on the daily chart that if you see on, or a weekly chart rather, don't think that we see these back and forth moves on the daily chart that now makes this a balanced price range. It doesn't. Because on the weekly time frame, it's inefficient still. The higher time frames have to have bodies hit the floor. That means it's got to cover that gap. Even though these individual daily candles have worked inside that range, that's not, you're seeing the formation of that weekly fair value gap with all of this in here on the daily chart. It's something you have to study on your own, working a higher time frame down to lower time frame. The higher time frames are parent. The lower time frames are subordinate. They're only going to behave in a manner that allows certain price delivery within the context and constructs of a higher time frame imbalance or liquidity pool. That's it. That's the liquidity continuum. What you're looking for. Market has to go up to a premium for what? Only two reasons. It's going up to take the buy stops, or it's going up to some inefficiency, some gap. Markets only go down to go to an inefficiency, a fair value gap below current market price, or it's going down for sell stops. I do not care. This is no disrespect to anybody else out there that teaches and made money. I don't give a flip. The markets don't go up and down because your indicator said so. The market doesn't go up and down because there's momentum of buying and selling pressure. That is not what is going on here. Okay, it's never been that way, but we have been led down the primrose lane with books, authors, teachers, whatever, saying that it's buying and selling pressure. It's not. These markets are absolutely controlled. Period. If we can see the likelihood of price action wanting to at least get up to this level here, why did I use that fair value gap? Remember, I'm painting why I said this was something important. Why did I pick that weekly fair value gap? And why did I want to see it trade through it and become support? Because it's at a level that on a simple run of the daily chart, using this dealing range, this low to that high, remember I'll add the fib back to it. Folks, this is real learning. This is the point. Okay, the point is you want to know what you're doing. If you want to go out there and gamble your money, go watch somebody else. Okay, you're welcome to do that. But if you want to learn, and you want to learn correctly, you're at the right place. That fib at 50 is halfway or equilibrium relative to this high and this low. So if I'm waiting to see price to try to gravitate to here, I want to see, does it perform what I would really rather see happen? I don't want to see it go up there and then sharply break lower, because if it does that, then I got to drop down to a lower time frame and look for a fair value gap or something else on a short-term premium to sell short, because it would likely run into these relative equal lows. But my experience in 30 years told me that all the factors that's going on right now in the world, geopolitically, all the turmoil, all the things that's going on, the economy, all that stuff is a cause for uncertainty. And because of that, I want to see, yes, my PD array is going to be a draw on liquidity. It's going to draw up to that weekly fair value gap. But I already announced to you that I'm going to see this do something other than just go up into it and treat it as an area to sell short from. I want to see it go through it. Does it do so? Yeah. Look where it closed. Above it. I did this stuff real time in live streams where I taught you how to discard or disqualify a fair value gap. So that way, it looks like cherry picking because I'm showing you examples, and a lot of people that hate me or trolls and people can't keep up with me, they'll insist that it's cherry picked, but they don't know the logic. And if they would just listen to me now, I'm telling you what I'm doing. So that way you can go back and look at the things I've shared and say, oh, yeah, there it is. Right. I'm not pulling things out of thin air. I'm pulling it from 30 years of experience. I authored these things. So I'm sharing that language so that way you can learn how to do it. So this fair value gap was the initial draw on liquidity. When we shifted above this high here, that candle right there that runs above that short-term high, that's a shift in market structure. Now market is in a buy program. A buy program is now when you start looking for premium arrays. Where do you look for those premium arrays? Well, what is the dealing range? That is this high to that low. We're only interested in premium. So we don't look at this short-term high as a turtle soup, run above and go lower. We don't look at this high here as a run above that and turtle soup and go short lower. No, we're looking for the first equilibrium or higher PD array. We started on the higher time frame. You want to do a top-down analysis because large institutions, big funds are going to be using higher time frame charts. So we're going to cannibalize their long-term models. Their long-term model through here was bearish. So we're looking inside the scope of this high to that low right there. Midpoint is here. That shaded area in orange, I'm assuming it's a hue of orange, but that shaded area, that's the weekly inversion fair value gap. That's the first level of my interest. Okay. So this specific weekly point of interest, I gave you the context as to what I want to see with it. It wants to go higher, great. I need to see something specific. I want to see it trade to it and through it. We've seen it close right there. If a market closes above a fair value gap that you think should be bearish, that's not a good shorting opportunity. Many times it's communicating to you that it will become an inversion fair value gap. Oh, there you go. The penny just dropped. I just gave you something again. But if you're not listening, okay, if you're not trying to filter out the buy and sell signals that you think I'm teaching you in Morse code. I'm teaching you specifics in detail. This is the point. You want to be trading with precision. You want to be able to read the charts without me and nobody else helping you and be independently wealthy. All these things have to have a lot of understanding and logic. So that way you can trust it. It's not changing and morphing all the time. The rules aren't changing. The goalpost is not being moved. You know that this logic is sound. You've seen it many times before and you can trust it. So that way when you go forward and you're in forward testing and then before a combine challenge or if you're trading with your own account, you'll trust it. You won't be nervous. It's the same type of thing like when you go to work. You know the different routes that you can take to get to work. Is the map changing? Sometimes there's a detour that's required. There's construction. Well, guess what? Sometimes the market will do a little hiccup and you didn't see a specific time frame do something and it might stop you out. Okay. Recalibrate like a GPS. What does it do? It reroutes you. As long as this objective of the weekly order block, which was the draw on liquidity, this was the multiplier, the inversion fair value gap. So I wanted to see, does it get to it and through it? Yes. Does it treat it as support? In the lower time frames, it does. And then trades up to that weekly order block, daily order block. And the last level you heard about was we want to see if it wants to get up to that 104.54, which is the weekly bearish order block mean threshold. Now, that's a lot of stuff. There's no way I could say that in less time and teach you what I just talked about. What was going through my mind? Why did I talk about that level right there? That is the shortest, absolute shortest way around getting between point A and point B to the point. That was the logic that I used. Think about how you could have said it with less words and make it make sense. You can't. So stop. Okay? Stop expecting something to be condensed when this is condensed. But it's specific so that way you understand the logic behind it. So now let's go into grading a price swing. So we have these levels here. The first one I drew your attention to was that weekly order block. Now, I could have very easily laid all these out here in advance and said, watch all three of these get hit. But you're learning. Your understanding is a graduated experience. And charter members could go right into this and see it right away. People that have been with me for a very, very long time. If you're new or relatively new, if I lay this level here, and what I'm about to say is not to be construed as talking down to individuals, okay? I'm just reminding you where you're making the mistakes. You are. I'm not making the mistakes. I'm telling you to be careful. But if I say, I like this level here, and you foolishly go out there and you try to trade with your money or risk your funded account on it or try to do a combine challenge and insist because ICT said it's going to go up here, between this point here and this point down here, there's lots of room for error. If you don't have a lot of experience or don't know what you're doing or you're impulsive and you chase price, even if you do use a stop loss, you'll get caught up in these retracements that you won't expect or anticipate. And you'll walk away thinking this stuff doesn't work. And then now here we are, it goes right to the levels that I've talked about. So between these two price points, with this shift in market structure here, and running up into that weekly bearish order block mean threshold. Again, this level here, right there, let me take the fib off because there's more lines on here that I want to show you. That level here is not anything in this fractal of any importance. It's the weekly chart. It's this one here. The mean threshold. This is the halfway point of this candle. And that's done by like this. You take the fib, drop it on the low to the high, bam. Right there. 104.540. That's why that level's there. It's half of that. Now let's drop back down into the daily. So we had a market structure shift here. And right away we have this fair value gap. Now watch, folks. This is not quarters theory, okay? Because you're going to hear somebody come out and say, oh, he's teaching quarter theory. I was doing this stuff before quarters theories was even talked about. This is what grading a price swing allows you. You have to know what? Where's the draw on liquidity? Where is the terminus? The end of the line. Where do you think price is going to go? It doesn't mean that's where it stops ultimately and reverses. Where do you see your setup form? Where's the framework? Where is the dealing range that you're going to work within? That dealing range is always in the past, high to low. We framed the equilibrium price point here, and we're aiming for a premium. Why do we want to see that? Because we want to see it trade into this fair value gap and above it, which would nullify, it would remove any need to anticipate lower prices on dollar. It's signaling to you algorithmically that it is not going to go lower. It in fact wants to go higher. So if we can do that, and we see it does, it closes here, that really increases the opportunity for this fair value gap to be inversion fair value gap. That means it's going to act as a resistance broken turn support, to use retail-minded logic. But this would never be construed as that because it doesn't fit any of the type of thing that you would expect with retail support and resistance. Nor does it meet the criteria for supply and demand. Before you go out there and you wreck yourself in your live trading or whatever, it's important to know these types of rules. Because if you are slow in making money and fast in trying to preserve or keep it, those two modes of thought or conducting a daily routine move very, very slow when you're trying to make money, because there's lots of opportunities to do that. Every single day there is. Every single week, every single day, every single session, there's something that you can capitalize on. Every single day. And in fact, specific hours of the day, you can trade 1 hour candles and treat it just like this whole idea that I've shown here on the basis of that weekly candlestick. All this stuff is applicable inside of a 60-minute candle. It all exists there. It's a tiny little universe within that one time frame. You can break these things down smaller and smaller and smaller. But you don't have the experience yet, and you have to give yourself the time to acquire that experience. And once you have it, then it gives you confidence. And you got to be very, very careful once you get that confidence that you know what you're doing, it doesn't evolve into egomaniac, attention whore. Okay? I was always that when I was in 20. When in my 20s, I this kind of stuff made me feel superior to everybody. And I communicated that always. And I don't, even though my stuff is superior, I don't view myself in a manner where I have to go out there and say and prove it. I don't have to do that anymore. I have students now that are doing it. This price range, okay, that I'm looking forward to if we get this shift in market structure, shift in market structure here on this candle here. At that moment, we have entered a buy program. So we have to go back into this range and anchor it to where we anticipate price going. that draw on liquidity. The initial one was here. This one, I don't believe I mentioned it, but I'm going to say I didn't. But you can see clearly it's anchored on the daily chart. But I did tell you this one here. This is where we want to see if it wants to get up into that. So all of this run here, we could be sitting still, anticipating, not reacting, anticipating a run above that short-term high here. Why am I talking about this high? Man, he finally talked about it. He's finally saying it. I've been screaming at this monitor, Michael, why are you wanting this high? Why didn't you use this high? Why didn't you use that high? Why not that high? Low, lower low, lower low. Okay? We consolidate. All through April and May, I'm outie. See ya. I want the market to show me something. So when I was down in Florida, when I was cruising around in my RV, and I don't live in an RV, goober, I want to see it move out of this range. Okay? Let's, just for a moment, let's ring in the bond market. Okay? If you are on Twitter, I believe it was Twitter. If it wasn't Twitter, either I did a video, short little video commentary on Twitter, or it was mentioned somewhere in my commentary on the YouTube channel. But I know I talked about it. And you'll see the chart right away and remember it, those who have watched it. But during this consolidation in here, I want to see it perform a specific way. I want to see it show me something. All through here, I wanted to see the dollar go lower. I expected it to take out that low. But because it was showing an unwillingness to perform or show any willingness to go lower, how did I get to the point where I didn't trust it? Talk about how when we don't want to take a trade, when there's something in the price action that says don't do anything. Okay, let's do that right now. Here we have this low right there. See that little pierce below it right there? Little tiny little short move below that low right there. It can and it could have very easily traded back up to this level and then resumed. If it would have done that, then the dollar really would have been bearish longer term. But because it consolidated, I want to see, does it have confirmation through the bond market? All this consolidation is going to be shown in the bond market. When I go to the daily chart for ZBM2023, which is a symbol that's used for bonds, it's not the month that you should be trading or tracking it now. Its volume has rotated into the September contract, but I'll show you what I mean in a second. To understand how the dollar is likely to perform, I use the bond market. Okay, and right away, some of you that just want to have one market, you want it to be real simple and short and sweet, this is where most of you drop off because you're like, oh, this is complicated. If that's how you feel, folks, don't watch my videos, okay? I promise you, you'll do something, either be successful at what you're doing or you'll hurt yourself, and you'll come back here and you'll learn how the markets really work. But this consolidation in here, I want to see, does it perform in a mirror image of what the bond market is doing? The bond market, ZBM2023, was in a range, okay? And I want to see it go down into a discount. If the bond market goes down in a discount, that would result in the dollar index moving into a premium. Here's that range. Okay, we were in this range, and until this range was given up, until it left this range, dollar wasn't doing anything. Equities were going to range bound. That's why I stayed out, taking RV road trips. I don't care about the price action when it's in here like this. Can I trade that? Absolutely. Can you trade it? Absolutely. But to meet a expectation in the community that's been craving higher time frame charts, swing trading ideas, can you do something off the 1 minute charts? I don't know why he's always talking about the 1 minute charts. The answer, the reason why, is because it gives me lots of teaching examples where I can call it before it happens and it pans out precisely. And that is where you should study. Whether you trade them or not, you should study those lower time frames because you're getting so much experience by using lower time frame charts, because it's not noise like the Goldman Sachs boys will tell you. There's absolutely a rhyme and reason why prices. Listen, is it a different price Okay, is it a different price if you're looking at the bond market, Bitcoin, gold, whatever it is, whatever asset you're looking at? Is price booking at a market price differently if you're looking at it on a daily chart or a 1 minute chart? If you were looking at right now, if you're looking at the bond market right here, this is live. It's not delayed data. Right now, the price is showing at 127 and 12/30 seconds. That's what it's showing right now. If I drop down into a 1 minute chart, look at that. Holy crow. It's the same price. So don't listen to these goobers that'll tell you, there's noise on the lower time frames. You're looking at the same price. Price is doing the same thing in all time frames, but the narrative as to what it's going to do next, is going to be derived from what time frame you're using right now. In layman's terms, I'll say it like this. It's going to behave in a manner that the higher time frame outlines. This is price action on the June contract for bonds. So you can see it's real spotty. Okay. If you use ZB, I'll come back to the daily chart in a second. I just want to make a point. Okay, that's the symbol that's being shown right here, ZBM2023. The M is the futures contract month code for June. All the volume is rotated into now the September contract. So that is going to be the U symbol. Watch how all these little dots become much more smoother. See that? That tells you that all the volume and open interest is now rotated early in the bond market. S&P, the June contract is still favored, but it will be changing here shortly. Now let's go back up to a daily chart for bonds, and I'll tell you what I was doing and what I was thinking. And I got to go to the June contract because that's what was being traded in April and May. Okay, so here's the business on the bonds. We were in this range. I wanted to see this break that range. Oh, he's a breakout artist. I knew it. ICT's a breakout artist. He's a break and retest guy. No, I'm not. No, I'm not. I want to see it leave this. This is market profile. Notice there is no volume bars to the right of my chart. Okay? I don't use that stuff. That to me is Mickey Mouse stuff. If you make money with it, God bless you. Okay? God bless you. Run with that idea. That's not what makes markets go up and down, though. Market profiles, to me, is a schematic. It's a behavior, a graph. Now, if you go into my core content on my YouTube channel, which was premium content, people had to pay money for that. Those lessons are the language that my students had to understand when I was doing, live educations and analysis every day. Every single day I was doing analysis, and I was on the spot every single day, calling every single day what it should perform. Where was this mad rush of people coming out and saying ICT's a fraud, he can't do this stuff, I'm paying him, he didn't call that right? It never happened. If anybody's going to expose me, it would have been those individuals that paid me. You're seeing the testimony again. It's happening in front of you. I'm teaching you the logic. You're getting it right from the source. I needed this range here to leave. I didn't care if it was going to go higher or lower because I didn't know at the time which one to trust. Because remember, on the daily dollar index, I wanted to see that low taken out. That's what I wanted. But I had to submit myself to what price was showing me. It was not willing to go there yet. So I had to take a step back and wait. Wait a minute, man, you're supposed to have 30 years experience. Right. That 30 years experience gave me the insights to say, sit still, bro. Sit down. This dance ain't for you. Sit down. Wait. Let the elephant enter that swimming pool. Think about a children's swimming pool. Okay, a little tiny little swimming pool. If a swimming pool the size of a child would use, if you filled it up with water and an elephant came over and sat down in it, what would happen to the water? It would be displaced, right? It would leave the pool, being replaced with the mass of that elephant. Smart money is like that. In this range here, right here, when we saw it close right there outside that range, that sets the stage for up move in dollar. But I have to wait. I have to wait for something. This is Wednesday, May 17th. Let's go back over to the dollar index. I know I should have charged you money for this. All right, so here is May 17th, there. Okay. Lo and behold, that's the day that the dollar index is trading inside of its fair value gap right there. Post a shift in market structure. So this high broke to the upside. How can we qualify that as a shift in market structure for the dollar to keep going higher? I just taught you. Are we seeing a mirror image that would constitute a expectation for the bond market to enter a sell program? That means bonds going down, dollar going up. Ooh. We're in a consolidation. We're in uncertainty here. So I have to wait. When this happened, okay, all focus goes to this fair value gap. But now I don't want to see it go up here to go short. Why? All this stuff that's happening in the other side of the world. I'm trying not to use words that will flag my channel because I've had friends that are not even technical traders or dealing with the markets, and they talked about these topics and they lose their channel. So I'm not going there. But just think geopolitical, WAR, all those things, all that uncertainty, the debt ceiling, the potential default, all that stuff was a catalyst from a macro perspective, which why I didn't believe that fair value gap would be a short. Now, if it would have went up there and started to sell off, like I said, I would use a lower time frame, 4-hour, 1-hour chart, short of a premium like that, and get in sync and then run for these lows here. But the context that I went into and I shared with you was I wanted to see that weekly fair value gap trade above it and come down and treat it as support. Look, this is the daily chart for the dollar index. Look where the bodies on the lower end of that gap. Look where the bodies were. Was that not respecting that weekly gap? That's not supply and demand. And that's not support and resistance. This is algorithmic. It's referring back to a level I drew your attention to beforehand. Now, how can I do that? I'm not a time traveler. There's logic there. That means there's something going on in price delivery that is well beyond buying and selling pressure. It's rigged. And there shouldn't be any reason for you to be upset about that. It shouldn't scare you. You should be thankful. You should be thankful that they rigged these markets, because that presents the opportunity that as long as you're in sync with what it's likely to do next, well, guess what? There's a 90% likelihood that new traders will lose their money in the first 90 days or less. That's a statistic. But on the other side of their trades, there are people with lots of experience that know what they're doing. They're the winner of those losing trades that the losing crowd loses to. There's a buyer and seller for every trade. It's a net sum zero game, but the game is rigged. There's no reason for you to be mad about it. Start punching the air. That's the reason why that broker did it to me. The broker didn't do anything to you unless you're trading Forex, because they have individual liquidity pools. When you're trading futures, you're all getting the same price. It's a gentleman's market. Okay. If you want to be a savage, you trade Forex. And when it's wild and it moves around, that's why I left futures, because, in the 2000s, it was wild. We had really big, wide price ranges and 300 pip range days on the regular. Well, that dried up and the market started getting real consolidated. So I went back to what I started with, which is index futures. I don't care if the S&P trades with a 5-handle day. And I said that correctly. I don't care if the S&P traded a 5-handle day. Folks, that's exactly what we were looking at in the 90s. That type of stuff in the early 80s and such, those days, that was like the normal. You didn't have this wild, crazy volatility. It's great, don't get me wrong, but if things got so slow and down to a snail's crawl in pace, that's okay. You can still do all those things in those very small little ranges. It'll just look like what the charts look like now, but the amount of movement will be much, much more condensed. And a lot of you aren't even prepared to trade in a market like that because you're so used and you're baptized in all this high volatility. When Forex shrank up and all the pairs had smaller ranges, social media, it was constant belly aching. Oh man, when's the big days coming? When's it? It's moving, folks. If you can get 10 handles or 10 pips from a price swing, that's good. What's wrong with that? What's wrong with if you just got 5 pips? Who cares if the range is really small? But you have to have your expectation calibrated to what the market profile is right now. That means we're in consolidation. I need to see what? I need to see bonds leave, because bonds will qualify whatever the dollar is going to do. I'm going to do a mirror image of it. So bonds broke lower. That means this is qualified as a break in market structure, and it's shifted higher. Fair value gap right there. Let's play devil's advocate and say for a moment, because this is a daily chart, and this is the dollar index, by the way. So if you're a Forex trader, this is the gold mine that you want to be in. Okay, this is where you want to be mining these things from ICT. The things that you think is boring, other people say it's bullshit. This is the stuff that makes you wealthy. This is the stuff that finds consistency and continuity in trading, longevity. You want to be around for a little while, longer than a couple months. Hopefully. It's this insight. This is the stuff that gets you there. Let's say that you saw this happen after the fact. You were working, you were sleeping, you have a business you're running, just couldn't be in front of the charts, and you saw afterwards the day closes like this. The very next day, folks, the very next day, what do you think the bias should be for your analysis? Bullish. Reaching for what? That fair value gap. So between the 17th of May until we got to the first objective, which is that weekly order block here on this day here. So from the 17th of May to the 24th of May, that run here to here, that right there is a sell program in euro. That means selling short. That means every day you're going in with a bias to go long in euro. It's also a bias to go long in pound dollar. It's also a long or buy program for Aussie dollar. It's also a long for New Zealand versus the US dollar. It is a short. I just said that wrong. You like that? I made a mistake there. This is where I wish I could go back and edit it. The dollar's going higher, so it's a short in euro dollar, short in pound dollar, short in Aussie dollar, short in New Zealand dollar, because the dollar going higher. Okay, it would be a long in dollar yen. It would be a long in dollar Swiss. Okay, because we're looking at, this is the dollar index. So if it's going higher, that range between here, by this day, it's after the fair value gap right here. Let me put it in the chart. Yes, my obsessive compulsive is flaring right now. It's all right. It just shows you I'm not AI. I made a mistake. All right, let's see. Extend right. Take that off. Okay, so there's your fair value gap. So after that forms, the next day here, until it gets to your premium array, where's the draw on liquidity? Weekly order block. What's the multiplier if you're a swing trader? It needs to find support here. So that sets the stage for your swing trade. But as a day trader, you don't need that. You're in there before that, which is why I don't do swing trades. I'm using the information I'm showing you here between this here, the very next day, and I apologize if you hear my stomach because I'm fasting right now. The idea of expecting higher prices on dollar index every day until it gets this objective first here, that sets the tone for a bias. That gives you your bias, because that bias is derived from the narrative that's being shown with higher time frame weekly and daily charts, also intermarket relationships, the bond market versus the dollar index, and market profiling. So we are in a consolidation. We have a shift in market structure. How do we qualify that? The range that I told you that bonds were in, I said, why is the market consolidating? Go back and look at Twitter. I tweeted it. It's there. The bonds are in a range. Until the bonds leave that range, all markets will be in consolidation, because interest rates are what makes the world go round. And then after that narrative is set, then we can have a bias. So the bias is bullish here for dollar, bullish here. It's even bullish on this day, but not in the scheme that we would expect it to open and then buy it and go up. We're in that range now, that fair value gap. So what we would expect is to consolidate or retrace, and does it support the low end of that range? And look at the bodies showing you that. That's a signature. That's algorithmic. So as a swing trader, you could use this day here as an entry and then pyramid in here for a run into that using that implied dealing range. An implied dealing range is not a dealing range like this where we have a real high and a real low. Those are actual. We're looking for a price run from this low up to this order block on the weekly chart. Until it does that, that's an implied dealing range. We don't know if it's going there. Anything can happen. A bomb could drop somewhere. Some kind of a hack that hits the markets. I expect that's going to be used in the future, by the way. But that run here, that is a implied dealing range. It has not really manifest yet, but we're seeing with anticipation that that's where the draw on liquidity is. The initial one was here. So now let's go and add our fib to this low. I know this stuff is amazing, and I could talk about this stuff all day long. All right, so right there, from this low to that high, which is the weekly order block, what I'm showing you there is the range. Okay, it's an implied dealing range. If we have that, look at the levels I have here. 75, 50, which is equilibrium, and 25. And then here's the high. The high of the run, which is terminus, at the end of the run, if you're going to use this as your dealing, well, not dealing range, if your implied dealing range, it's where you think it's going to go. So before the candlesticks even form, folks, you could have this in your chart like this. It would look like this right here. Okay, say it's meandering around like this in consolidation, and you just start doing your analysis, and you think, okay, what happens if we were to break lower in the pound? I'm sorry, if we were to break lower in the bond market, then that would give rise to the dollar index. High, low is your dealing range. Weekly fair value gap. Okay, that sets the stage for, if we're going to go higher, I'd like to see us remove this bearish stance that I hold on dollar during this time period. If it goes to here and goes above it and treats it as support, I'm not bearish on dollar. Go back and listen to my reviews. It's there. It wasn't word salad. It was very specific. But because we have this range here, we can take the low up to that weekly order block. Let me take the fib off and show you what you would be doing. This is what you could do here. I know some of you are brand new or this is the first time you've seen this. Oh, this is hindsight. Go back and look at the reviews, folks. I was talking about all this stuff before it happened. I didn't give you this much of a breakdown, but I'm teaching you how to create a price swing. How to anticipate where the next setups are going to form before they ever come into the chart. Forget supply and demand. Supply and demand requires the candlesticks or ranges to be in the chart. I'm going to teach you where they will form before they will form. Where do setups form? Show me how to buy and sell, Michael. Where are these PD arrays that work? How does it look in the chart before it gets there? What should I anticipate? How can I trust this stuff? Okay, let's do some time travel. Low to high, that's terminus. We have 25%, 50%, and 75% of the range. We require bonds to do one or the other, go up or go down, and leave that range I showed you on its daily chart. It broke lower. Not yet, but now we have let go of that, Michael, good grief. We have a shift in market structure right there. On the bond market, we qualified it with it going lower. It left its range going lower. That's going to give momentum to the upside on longs. Not that that's driving price, but that's setting your mindset in motion for it. We're in a buy program for dollar. So right away, we can anticipate somewhere in here, in this area, there's going to be some kind of accumulation. We consolidate here, and then we run. What does that make that right there? That's a fair value gap, right? Yeah, it's a fair value gap. More specifically, it's a breakaway gap. What is it breaking away from? It's breaking away from this consolidation. It has a shift in market structure. So this is your gap to trade. This is the gap that you use to qualify as a breakaway gap. And then trust it's likely going to draw here, which is why I communicated to you. I said, we want to see this traded to, but I'm more interested in trading it up above it and coming back down and finding it as support, which makes it an inversion fair value gap. Now, I know if you're new, this sounds like a whole lot of stuff. Please just give me an overbought, oversold indicator and a moving average to follow. That's okay. You're not ready for me. That's all that it means. It doesn't mean that you can't learn this. It just means that you're not ready yet. Go watch somebody else. There's lots of other people that will entertain you and tickle your ears. You want to learn how to read the markets and really know what to do? Come back here. 50% equilibrium. Look where that fair value gap forms. Equilibrium. Ooh. What do you think's significant about that 50% level? And why didn't that gap fully close? It's a measuring gap. That fair value gap is a measuring gap. This low, this candle did not come to that candle's high. Uh-oh. We're seeing some context and narrative that just ain't in your books, baby. That means we can anticipate this price run here to be duplicated to the upside. Meaning, let's say we have this low is lower than that low and relatively equal to that one. We don't need this low here. We want to see the energetic price run. That's this one here. So where does that root price run begin? That low right there. So if we take that and measure it up to the high of that fair value gap, why that? Because that's the highest range. So you want to use that as your base point. Extend it from there. And you're putting it right on that same. I'll show you exactly what I'm doing in a second. Give me 1 second. I'm taking that high of the fair value gap. Here's the low of the fair value gap. I've duplicated that. So we now are seeing a range that's projected to go above this gap, which is why I was saying I want to see it go through it and then treat this gap as support. This was the draw. Now, it does go through it. Here's the upper 25% of it. Okay? It comes back down, immediate rebalance, 1 day delay. Remember when I talked about immediate rebalance? It's that next day or the very next day after that. Then you'll see the price run. There it is. Goes into the weekly order block, trades up into the daily order block, and the weekly mean threshold order block. Trades all the way up into those levels. Each one of these targets, okay, you're looking for price to continuously reach for them. You don't want to think that, okay, this is my first objective, and then once it trades there, go try to find some other setup in another market. No, you want to stick with it. Does it continuously keep digging into that? The next level, it does. Okay, the last review I did, I said, okay, this is the level we're looking at next. We want to see if it wants to reach up in that 104.54. It did. Every time it was digging higher, I literally watched people on social media bitch about their long positions in euro failing. This is the reason why it kept going higher. If the dollar's going to go higher, euro is going to fall. It's going to go lower. And then it drops from there down to some random level, which is, let me get this off here. Down close candle. Inside the weekly order block, weekly fair value gap, which is now an inversion fair value gap. This is the treatment of it on the daily chart. It comes down, hits it. Look at the reaction there. Do you think you could have took shorts in euro dollar on that right there in the last 1 to 3 days? Well, let's go over to euro dollar. Finally, get the hell off of the dollar index. Get to something that makes sense. We don't trade the dollar around here, right? So here is the euro dollar. And this is the daily chart. And this is the immediate rebalance right here on euro. And this was the fair value gap I mentioned that we would draw down into up here. We drew down into it. And then we rallied one more time into this up close candle right here. That's a bearish order block. Oh, here we go with the hindsight. Folks, listen. Your surgeon that cut on you and did your surgery before he got his license, he was cutting on cadavers. That means dead people that can't sue you. So That's hindsight too. He's looking at something that is a safe. He doesn't want to do exploratory surgery on you while you're living and try to do new things. They have to do those things clinically in cadavers, bodies that have been offered to science for research. You need to go through these exercises yourself. Look at price action, study it, not just recently. Go back through all of this stuff here. And that's what backtesting is. It's not going into a Forex tester and testing the thing that's a mock-up forward test without live data. That's a stage you can include, yeah. But when I say backtesting, you're going through old moves and studying it and breaking them down. Like you're really going in there in detail, looking at what it's done, what it didn't do, where you would have been stopped out, and being honest about that. How much risk would have been incurred, not using the best entry. Use the worst potential entry. And does it pan out still? Okay. So here's the fair value gap I told you we would gravitate down to. And let's go back over the last few days here. Here's your order block here on your daily chart. Let's drop into a 60-minute chart. In this high down to that low here, do you see anything that stands out? I'll give you a minute while I get a drink. Well, what did I just teach you about dealing ranges? You break the dealing range down. If we were seeing the dollar trade down into that inversion fair value gap on the daily chart, the inversion fair value gap is based on its weekly chart. That is a discount for the dollar. We could likely see it rally. Dollar rallied. That means that we're likely to see euro dollar sell off. How can we anticipate that? And where would it form? Here's your high down to that low right there. Where's equilibrium? 50%. Right here. In close proximity, what do you see as a PD array? That would be at that level or higher for a premium. Remember, if we want to be short, the highest probability shorts are occurring in premium markets above equilibrium. Continuation pattern or continuation premium for selling short in a bear market that's been a bear market for a while, you can sell right at the 50 level. But specifically, in a premium, we want to see it get into this range here to here is premium. In that range, between this low and that high, where is the PD array that the first one exists at a premium in that range from this high down to that low? When we retraced higher, went into this area right here, it went to this fair value gap, which is a SIBI, sell side imbalance, buy side inefficiency. So if this is what you saw, congratulations, you did it right. And it trades up into it here. Dollar goes higher because it's on its inversion fair value gap. Euro dollar sells off. This area right in here also is running what? Buy stops. Retail traders see this run here and all this consolidation. They see that as a bull flag. So they're thinking something like this. Euro dollar's been going down for a long time. It must have made a low. And they see this right here as a flag pattern. You see how it's like a big flagpole consolidation. And they think if it can break above this high here, it will duplicate. It'll duplicate that same run. Oops. Once we break the high, they want to see it trade back up in here or something to that effect. And I'm doing it very loosely because bull flags and bear flags are trash. But the logic here is opposed to what a retail-minded trader would see. And it's taking liquidity into account. That means the market went lower, we traded here, and we started to move a little bit here. Nobody in their right mind, keyword, would have trailed their stop loss on shorts to that level right there. But on this move lower, I promise you, every Tom, Dick, and Harry out there that's trading Forex, because they're ultra scared. They don't want to get stopped out. They don't want to have their profits erode, and they trail their stop loss too tight. And you know who I'm talking about. You're nodding your head thinking, stop talking about me. There's liquidity above old highs and lows. That's 101 in terms of understanding where markets are going to reach for liquidity. But if you can see that liquidity and pair it with some retail-minded idea that would be opposed to what I'm teaching you. Remember, I'm teaching you how smart money sees price and engages it. I'm teaching what the algorithm does. So the algorithm will deliver price above this high to take into account for buy stops being brought to the marketplace. Those market orders are now buying at the market, which is what smart money will offer shorts to the marketplace at that same time. Where, in what price range? In this fair value gap. Where would be the opposing draw on price once it went into here? Right above this high here is the buy stop. So it trades there, which is the opposite of what we saw dollar doing. At this moment right here, dollar index, let's see here, right at 2 a.m. on Tuesday, June 6th, okay, 2 a.m., the dollar index was making that low here on the fair value gap. See that? So it's a mirror image. So you're qualifying setups, not just on the basis of you see it in your chart you're trading. You have to use some intermarket relationships that would say the opposite. For instance, if we're trying to go short on euro, you want to see something that would constitute a long in dollar. If you can't really see it in dollar, that's opposed to your cable trade, which is pound dollar, or fiber, which is euro USD, whatever you're trying to do in your Forex pair, it needs to be in a setup that would be opposing in the dollar. If it's a Forex pair that has a currency other than the dollar in the first of its name. If we see this setup here that's potentially long for dollar, which is we're trading in that fair value gap, if we're expecting prices to go higher for dollar, we would look for pairs that begin with US dollar in their name, like dollar yen, dollar Swissy. Those pairs would mirror what dollar index is doing, which is go higher. But because the dollar is likely to go higher here, and euro dollar being inversely related to it, it's going to go lower. But it's not randomly just going to some level and starting some, mystery as to why it was going to go lower. It's what I'm teaching you. This range, the algorithm refers back to it. So it only needs to go up to equilibrium slightly higher. So we measure that with the 50 level. That's the only thing I'm using the Fibonacci for. I'm not using Fibonacci for entries. I'm using Fibonacci for premium and discount range, delineating a specific range to know where a setup should likely form. But in that range, what range specifically? It's this. There. Somewhere in that portion of this price leg lower, I'm going to look for a premium array. Well, which ones exist? We have the fair value gap here. Man, I should have charged money. Good grief. This I could have made easily $100,000 on this. I'm being facetious, folks. Relax. So that's the first one. That's your first premium array. Using month 4's lessons on the PD array matrix. So what's the next one? Are all down close candles, back and forth price action. So all of this right here, this is balanced. We've had lots of up and down movement in here. And then we go back to the old high. So we have an order block, which is the last up close candle with the highest close. So it would be the opening price that would be delineated there. Why would it need to go there? It doesn't. Because it's shielded by all of this up and down movement. There's no inefficiency. None. Zero. So what PD array do you use? That one. Which did the market use? That one. What time of day did it occur? London kill zone. 2 o'clock in the morning. That's what I teach you. What's the opposing draw on liquidity? Okay, say you got this much right. How do I know where price is going to go to next, Michael? Because that's what you're all wondering whenever I tell you something's going to happen. I say, okay, here it is, folks. You know, it panned out. Invariably, folks will come out and say, all right, what's next? They're wanting me to get it wrong. they want me to get it wrong so they can say, ha ha! You had 9,000 times in the recent that you got it right. But look what you just did. You missed on this one, buddy. Ha ha, you're a fraud, scammer. You can't win with some people. But if you're looking at that as liquidity here, okay, and we're at equilibrium or higher, that means we are truly overbought. There's no indicator required to see that. You don't need to put a Williams percent R up. You don't need to put a stochastic up. You don't need a CCI. You don't need a MACD. You don't need any of that stuff. This chart is only showing you ranges being measured, which is what the fib is, and then looking for inefficiencies or liquidity. And I draw that out on the chart so that way you can see it. It gives you like a visual eye candy that your attention is focused at a specific area on a chart. And then I go and I talk about what that is so that way you can see it and understand how to use it going forward. So at this moment right here, if in fact the market does go higher, to take the buy stops here and just trade into a short-term premium, which is relative to this dealing range high and that low, hopefully you guys can see this run from this high down to that low prior to that retracement. This is a significant price swing. Like, I'm not looking at like this little thing here to here. That I'm not concerned about that. I want to focus on intermediate term price runs. Regardless of whatever time frame I'm looking at, my eye goes to specifics in price action. I'm not just taking every little micro price swing. I'm looking at from here to here. Maybe from here to here, but from here to here, absolutely. And whenever I see these ranges on the weekend or in the morning, I'll go through my charts before the kill zones or before the sessions begin. And I'm doing this with all the ranges that are salient, which is daily, 4-hour, and hourly, and 15-minute. So I'm looking at all the potential dealing ranges that the market may refer back to. And then I weigh out whether or not, like I just did with this price run here from high to low, how many PD arrays are there? See, you think because I've taught you the propulsion block, fair value gap, institutional order flow entry drill, bearish order block, vacuum block, all those things, you're thinking, okay, which one do I use? Here's a perfect example. Which occurred in that price run? Just the fair value gap. That's all. And it only needed to go up to this level here at the same time it went down to its fair value gap on the dollar. Dollar went down to a discount. It's bullish. Euro went up to a premium. Bearish. Time of day, 2 o'clock. What's the candle here? What's the time? It's always local time, New York. Your trading view chart should always be set to New York. That's the time that the algorithm runs on. I don't care what anybody else says. Okay? This is the way it's coded. So it reports on time, on duty, at 2 o'clock in the morning. After hitting this, then price is allowed to run. Higher, 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 higher. Then at 2 o'clock, off to the races. Boom. What's it going to reach for? How do I target a run like that? Where does it go to next? Well, if it went up to the buy side, here, and it went into inefficiency, here, it's in a premium above 50%, and the dollar's looking to go higher, it's in a short-term discount, it's in a fair value gap. Nothing says the dollar topped. I don't try to pick tops. I'm trading in the middle. You don't need the precision highs and the precision lows. You don't need that. You try to avoid that when you're using higher time frame charts. Try to avoid picking tops and bottoms on higher time frame charts. You absolutely can pick tops and bottoms in the lower time frame charts because they're going to behave subordinate to the higher time frame. What do I mean by that? If we're bullish on weekly and daily charts for dollar, it's real easy to nail down right to the pip short-term lows at key times or kill zones for dollar index intraday. It's just using these types of tools here. But if you're going short here and you're looking for the opposing draw on liquidity, that's this low right there. What's the reason behind that? What would be at that low of any importance, and why would it want to revisit that low? Because it was a sharp rally here. This induces traders to go long. The pattern that they formed here is a pseudo bull flag. I teach that in the core content. Where do fake bull flags occur? In this situation like this, and what I teach in the core content. It only goes up enough to validate the buyers on breakout on a bull flag, but it only really goes up to where I teach you. The algorithm sees this area right there. It runs above that short-term high here, and then because it took buy stops into the marketplace, smart money goes short here. So they're selling short here at the buy stops. So two things are being accomplished here. Fair value gap, premium. It trades up into it and takes the buy stops or buy side liquidity right there, this high. So your chart would look like this for annotation purposes and for your journal entry. I know, man, this is awesome, isn't it? You're all thinking, I wish I would have known this stuff 2 years ago, 6 months ago. I know. So those buy stops, that buy side liquidity has been purged. So if smart money is selling to those buyers, what are they trying to get out at? A discount. Your eye goes right to where retail would be trying to be fortifying or protecting their position. What will be resting below that low? Sell side. Doing a clinic today. Give me a thumbs up if you want me to do one of these every day this week, except for Friday. I got plans on Friday. If you want to see me do this every day this week, live on YouTube, and teach you stuff that will knock your socks off, thumbs up this video or this live stream. Like that? It's pretty fair request. So the market drops precipitously and goes right to where the sell side liquidity is. See that? Now, what you want to study is, because we have that gap, this old gap here, that's a daily. Let's go back to the daily real quick. That's this fair value gap right there. Okay. Because we're inside that range and we're here, we have a gap that's outside of it. You see that here? We have that right there. And we have this up close candle right there. So this is a bearish order block, and it's also right in the middle of that shaded area, which is the daily fair value gap. So this is consequent encroachment, essentially right there. So in my mind, if we want to take this low here out, where another level of sell side would reside, how I'm doing that, in case you're wondering, I highlight it by clicking it when they have the little balls on each end. You go anywhere where the ball isn't, and you hold down control and drag it away from it, and you can create a duplicate. And then drag this over, hold down shift, and it'll make your line straight. I learned that from my students, so I'm very appreciative of that. Every time I do a live stream or do a video and people watch me do things on TradingView, I always get emails, messages, or whatever saying, here's a tip for TradingView. And I love that. Thank you so much. So you'd be watching this. There's your order block. And I would want to see it stay below this candle. More specifically, using that level here. But if it trades above this candle here, I would be sitting still on euro. I'm not saying it's a short, but for me, if it wants to go lower, it would need to see that candlestick, keep it at bay, and not trade back to the high end of the fair value gap on the daily chart. It doesn't need to do that. Because if it does, it means something altogether, something else. And it's not a trading environment for me to do if I was to look at it that way. And it's already fulfilled a role here. It took buy stops and then sell stops. So in my mind, it can consolidate. But if it wants to go lower, it would need to stay in the lower half of this shaded area right in here. Okay. All right. So that is the business on that. I talked about breakaway gaps. I talked about PD array matrix and how you shouldn't be worrying about which PD array. You trade the one that the market gives you. Not all of my PD arrays are going to exist in every price run. I mean, that's an epiphany right there for some of you, because you think that every single one of those PD arrays exists in every fractal of price action. It doesn't. So when I'm looking at price and the people that don't like me, or they sell something, they view me as a competitor, they try to derail your studies and put nonsense about me out there, make up lies and whatever, Photoshop stuff. They can't erase the fact that I'm calling it before it happens. And they can't erase the fact that my students are now making fortunes with it, with real money, and leading the pack in profitability. So we are the cult of profitability. You want to be a cult member? Sign up every day and study. Okay, it's free. You don't have to give me a PayPal payment. You don't have to give me your credit card number. You don't have to do any of that stuff. I don't run Discord channels. I am not teaching you crypto. If anybody says anything that I'm touching crypto, they're a fraud. They're a scammer. I am not doing any of that. I'm not running some private little area, drawing people in. You're never going to hear me say, you want to join my private mentorship for money? If they're telling you that I am offering that, that's not me. Drop it. Don't do it. I'm not charging you. I'm gladly doing this. I'm enjoying this. And it doesn't cost you anything but your attention. And then you have to study it after we spend time together. So I've covered what I want to cover here on Forex, but let me just drop into Cable real quick. I haven't looked at her for a while. Okay. Yeah, I would have preferred Euro over Cable. Cable doesn't have all that much clean run in here. This is too muddy. Muddy meaning it's got like a small little gap here, another gap here, and I don't like that. It's not as clean and obvious. No. Take a look at this chart in this area here. Okay. Look at this area here on Cable, which is pound versus US dollar, pound dollar. Look at that and compare it to Euro. I'll toggle back and forth for a second. You see how obvious that is? That gap really stands out, and it's singular. One of them. Versus same area. Look in your Cable chart. Gap. What's cleaner price action? Euro. So if I were trading last night in London session, which one would I have traded? I would have traded Euro. I would have not taken any trade in Cable. Even though Cable did in fact run lower, it didn't go down to take out its sell side because it only needed to go down into this imbalance here. And that's where we saw it trade to. So I wouldn't touch Cable here. But Euro dollar last night was really nice. And let's take us into the weekly chart. And let's look at ES. And then bring this discussion today to a close. I know. Can't you make it one of those 4-hour sessions? Nah, not really. Because if I'm going to do this every day, I want to kind of preserve my voice. All right, so here is the business on the weekly chart for E-mini S&P. So for all you diehard Forex folks that don't think you're ever going to learn anything from me by teaching Forex concepts in ES trading, because it's not limited to just Forex in my stuff that I teach in ES, unless specifically stated, it's price delivery. So Smart Money Concepts, SMC, that's my work. These are my creations. This is my stuff. If you want to learn how to do this, I'm showing you it doesn't have barriers by asset. It's not limited. So because my focus has been primarily on index futures, all the teachings obviously are being seen in this medium or asset. It doesn't mean that it can't work in Forex or that it stopped in Forex. It just means that my attention is in this market here. All right, so now think about what we were talking about in relationship to the bond market. Okay, now we're going to take a little bit of a step back and think, if the bond market is signaling that it wanted to go lower recently out of that range, and I'll take you back to that chart in a second when we get to the daily chart of the E-mini S&P. But that bond market moving lower sets the tone for a market that will see movement, because we left a range in bonds. So therefore, all other asset classes are free to move. They're free to move. And they leave the consolidation. So once we are in that profile, the profile being we're in a trending environment, not consolidation. We're in trending. That means that price swings can now evolve and allow daily charts to start booking sustained runs, not just intraday volatility only, and that's your cuisine you have to eat from. It's a little bit more of a sustained price run when the bond markets are trending. If the bond market is consolidating, that is a true testimony to anticipate consolidation in your specific market, whether it be bonds or whether it be index futures, whether it be Forex. It is a precursor to tell you what type of environment we are in from a macro stance. It does not mean that you can't make money within that or outside of it only. It just means that from a market profiling stance that I call profiling. It's not the volume profile where you see all these little horizontal volume indicators and such. None of that is necessary. VWAP is not necessary. Level 2 data, not necessary. All those price action junkies that use the ladders, on the right side of the chart. It looks cool, don't it? Seeing all that stuff flashing around. That's distracting. You don't need that. Everything you need is in the chart. A time-based chart will give you everything. You'll be able to forecast where and when they're going to form. And those folks are waiting for something. They need it to go to those levels. And sometimes they don't work. When I'm teaching you how to anticipate where and when these things will form. And by doing it over time, you desensitize yourself to the uncertainty where it's paralyzing fear right now. You're like, I don't know what I'm doing. This is so complicated. Go slow. There's nobody, I'm not telling you should be trading with real money in your first year. So why are you insisting that you should? Just because everybody else out there is doing it. You don't know how long they've been studying. You don't know how long they've worked very hard. And nobody comes out here, Johnny on the spot, first time, never failed, and is a superstar. Nobody has ever done that. Okay. They've always had some measure of learning that's required. And some are faster than others. And give yourself permission to grow at your own pace. I'm not grading you on the speed at which you find continuity and consistency. So don't you do it either. Now, we are, make sure I'm looking at the weekly chart for all right. Weekly chart on E-mini S&P. When we were down here in this gap here, I said we were going to look to trade up into this volume imbalance, which is the shaded area in white. The volume imbalance is the opening on this candle here and the closing on that candle here. There's no body by any candlestick ever since that formation there until this candle and this candle, which was last week and the week prior. Notice that? So this was the draw on liquidity. And then I said inside of, you want to see the real sweet spot, would be that little separation right there. This separation there with the blue lines, that, my friends, is a real liquidity void. That's an absence of any trading. No book price, no delivery, no trades were engaged, no stops were taken, no entries were given.
There's no trading between those two price points. So while this was enough for the draw, which is the volume imbalance, because we only had this little wick between this closing price and this opening price, my eye jumps to that, and you can see the other one that I'm looking for. If we continue on the upside, it's here. That's where I see it, right here. That same thing, this right here looked like that here when we were down here. I said, watch this fair value gap and this order block, the opening price extended out. Don't take my word for it. I have it in recording. Go look at it. It's on the YouTube channel. I do not delete tweets. I do not change anything on my videos. Once they're up there, you can't edit them. They're there. So we did, in fact, draw higher. Now, here is one of those things that's making a lot more sense for the diehard students here that really want to know what it is that makes price behave a specific way. Bonds move lower out of the consolidation, freeing up the markets to behave in a manner that's trending, causing dollar to go higher. Dollar going higher is what? Risk on or risk off? Risk off. Meaning foreign currencies go lower. Meaning that the rallies in equities, while they still can manifest and materialize, they're going to be held at bay. They won't be explosive types of runs. They're usually going to be like that. Keep on creeping higher, small little retracements, creeping higher, creeping higher. So that's profiling. That's market profiling, understanding the behavior of how price will deliver. Now, let me make a distinction and contrast it with something like this. Let's say, for instance, that we did not need to come back up to here. Say all of this didn't exist as a volume imbalance, and we didn't have this gap here. Okay. Then E-mini S&P, NASDAQ, and Dow could accelerate lower in shorts. But because it is being manipulated heavily, the stock market should not be where it's at, folks. I'm going to be real honest with you. This thing should not be here. But I have to follow the breadcrumbs that the algorithm is laying out there, that this is what the smart money entity, the people out there that's not making video courses and not on YouTube, they're not on Twitter, they're not on TV, talking heads, they're not out there telling you what to do with your money, because they're out there actively fleecing large funds. They're trading against them. They're their counterparty. They're the people that are inside the measurement of net trader position chart. When you see the large traders, when they are trading, they're opposed to them. They're providing the liquidity. That's smart money. And they're constantly in a dance with large funds. Constantly. You learn how to place your stop loss with the same logic that they do. And that's why you fall victim to it. So while smart money's not out there looking for your one micro lot on Forex or your mini contract in S&P, they don't see you. They don't see your one contract that you're trading. Okay. They don't see your micro contract, your little tiny insignificant anything. They're not looking at you. They're looking at the large pools of liquidity that large funds bring to the marketplace. And just like a large fishing boat that drags a net, okay, they're out there trying to catch fish. But sometimes these innocent dolphins and sea turtles get caught up in that net. You're that dolphin and or sea turtle. You just are a casualty of an event that's going to happen whether your stop was there or not. So they're not out there to get you. They're out there to get the large fish. And if you're in the wake or in close proximity to where they are, you're getting scooped up in that net too. So it's imperative that you understand how they go after that crowd of large liquidity. And you have to learn how to navigate. Certain markets are going to behave in a behavior that is explosive sometimes, and other times it's just something you just can't, you shouldn't be fighting it. We've been calling ES higher. We've been looking for these very specific levels, and it delivered like gangbusters. I told you that NQ or NASDAQ was the stronger to the upside. Why didn't you do all your trading in the NASDAQ? Because I'm teaching that if you use one medium, one market, you can use even the stronger market to trade this slower market in sympathy. It'll move with it. Meaning, look at NASDAQ. NQM2023 on the weekly chart. Which one was more explosive? Clearly, NASDAQ. You were told that NASDAQ was the stronger one to the upside. So the sixth sister is what? ES. So ES will move slower. It'll still go higher. But this imbalance over here strongly and quickly reached for NQ. Back to ES, we have not even made its way up to that respective imbalance, this volume imbalance. See that? Still, ES has moved higher. But it does what? Performs lethargically, as I told you it would, because NQ was stronger. I'm teaching you visibility. I'm teaching you how, even if you were only following ES and you never wanted to touch the NASDAQ, because NASDAQ is a little bit wilder. It's thinner. And because it's thinner, it moves faster. It runs for liquidity faster because there's less contracts in close proximity to market price. So it will quickly run farther away. It will run 100 handles faster than ES will. It doesn't need much to do 100 handles in NASDAQ, which is why you shouldn't be doing a lot of contracts in ignorance, not knowing what you're doing. That thing will roast you, rip your face off, and cremate you right there where you stand. But I can teach you how to find when it's going to be an outperformer. Sometimes NASDAQ will be lethargic and it'll be reversed. ES will outperform it. Somebody that's new or recently just started trading, they would think there's no way that's like that. Listen, I've been around here for 30 years. I've seen it. But to know what it's going to do beforehand, that's visibility. That's experience. You're learning that. You experienced it real time with me over the last few weeks. The benefit is now knowing what it did, you can see that we have tools, I have concepts, I have logic that can be transferred to you and your understanding. And you can take that going forward. And also to relieve the people that are new. And when they hear me say, just follow ES, they're not upset because ES didn't perform. Now, if you're looking at saying, you told me to follow ES, I'm studying ES. And even though you did say NASDAQ was going to be the upside leader and stronger, I'm studying ES and I'm regretful because I could have took live trades before you should have and made money in NASDAQ. You're a jerk. You're a terrible mentor. Well, that's a student that's not really trying to learn. That's somebody that is going to look for fault in anything external apart from them. The reason why they didn't make money or more money is because of somebody else. The reason why they lost money is because somebody else caused it. They're never going to be responsible. And you have to be responsible. You are in a driver's seat. Nothing I tell you should be a reason for you to press a button to get in and risk real money. Nothing. Not one thing. Which is why sometimes I'll say, like I mentioned when the senators were all given satellite phones ahead of the Memorial Weekend. I said, anything can happen, folks. Don't bet the farm on it. Be careful. Because I know there's a small group of you, probably larger than I realize, that are taking what I'm saying and going out there and trading with it with real money. So I want to remind you there are real risks here. I'm never painting this and you're going to get rich. I'm never doing that. But I'm teaching you and promising you that you're going to read price action better than any book, course, or educator is ever going to take you to. They're never going to get this. They're never going to get like this. There's so many facets to this stuff that helps you become a freak, a precision freak. And when you are understanding the markets to this degree, in this depth, there's no reason. You never are scared. You're never fearful. You respect the risk that the markets provide and offer many times. But you're not paralyzed by uncertainty. You know exactly what you're looking for. You know what you're going to wait for. And when it forms, you take the trade, you take the entry, you know where your stop's going to be, you know where your first partial, you know where your second partial, and where your target's going to be. You're not worrying about it because you understand yourself and you understand what the market's likely to do because you've been studying it with great detail. Not just, let me watch a couple videos of ICT. I got this lick. Let's go. No, that's not how this works. So ES, we had a real gap here, and that was where I took your attention to very specifically. Look here, that's going to be the draw. Imbalance, fair value gap, rallied right in there. So in between here and here, let's do the same thing we just did. There's our low. That's where our price point started, up to here. In that run right there, you can go into the lower time frames for your own homework. I'm not going to do it here. This is for your study. From here to here, on your fib, let me help you also, because I know some of you are probably saying, can you open up your settings? He read my mind. Here's what my Fibonacci settings are. Okay, so I'll leave that up here for a second so you can get it. And these levels down here, the 0.25 and the 0.75 with 0.50, that is going to give you your gradient levels for grading a price swing, which we're going to go into next. Okay, but on the lower time frames, like 1 minute and 5 minute charts, look at that range around the 25, around the 75, the 50, and the 25 respectively, and see if you don't see my PD arrays manifesting there. We have this run down here. Same thing. You're going to do this is for homework. From this low up to the high of that gap right there. That's the draw. So if you were a swing trader or a short-term trader or a day trader working within this profile trying to find longs, where do they form? Price-wise, it's around this gradient, the 50%, and the 25%. Go into your lower time frames. I could make this a 5-hour long video, which I don't want to do. But I promise you, if you go into your lower time frames, you're going to see these levels. There's PD arrays and setups that form there. Study that. Okay. This will help you see algorithmic price delivery and that you can anticipate them. Where everybody else out there is waiting for something. Let me ask you a question, okay? For the folks that trade market profile and trade with VWAP. Where's VWAP going to be on Thursday at 10 a.m.? Right. I can tell you where price is going to be, and then I have elements in time that I use where I know they're both going to meet. See, you're a victim. You're a casualty to uncertainty, and you have to wait around for something to react to. Just like an overbought or oversold, you can't do anything until that overbought or oversold indicator tells you. You can't do anything directionally until your MACD says it's sloping down or it's sloping up. I don't have that. My students don't have that. And when I talk to you this way, I'm not trying to be arrogant. I'm not trying to be condescending. I'm telling you what I'm doing is light years ahead of everything that you're doing right now. That's why when my results are being shown to you, it looks like cherry picked. But what do you do when I'm doing it with weekly charts now and daily charts and it's delivering? How many things did I say in addition to this that didn't happen? It was only this. And I say these types of things because I want people that are on the fence that listen to these goobers that just don't like the fact that I'm doing this for free and I'm that good. They want to take your attention away from it. And I'm trying to be respectful to them because I could literally go out here and smash all of them. But I don't want to do that. That's not why I'm here. I want to leave in November, on a high note, a good note, where I'm not adversarial to anybody. And I want even the people that don't like me and are selling other courses, I want them, whether they openly say they did it or not, they can secretly add all the stuff I'm teaching. If it makes their product better, that makes them better. And that makes their patrons better. That's all I care about. I don't want to hurt anybody. I don't want to make anybody, lose their business. Okay. I want to help. That's all I'm doing this for. I love it. I enjoy it. And I'm passionate about it. And it's not limited to just the people that like me. I have a lot of people that are long-term followers that were haters of me in the beginning. So let's go into a lower time frame discussion on ES. Let's go down into let's just drop down to 4 hour. So here's that daily discount fair value gap, and the market rallied, consolidated, worked inside of this imbalance and into this breaker. We have a low, high, lower low. Last up close candle, extend that in the future, hits it here, hits it here. My eyes don't, I gotta look at it and see. I'm not sure if that one hit it too. Yeah, it did. So it hits it here multiple times. Okay. Now, this breaker is not a supply and demand zone. Okay. Sam Seiden and those who follow him, if they were to see that as a demand zone, okay, now it's no longer fresh. It's definitely stale bread now. It's a crouton. They would never use that logic. Okay. My PD arrays, as long as the narrative stays intact, looking for higher prices, these PD arrays can be reused. Okay, their sponsorship doesn't expire simply because it's traded to it before. We're in a large consolidation here, buy side here. The market rallies up, creates another area of equal highs. It drops back down. Where's it dropping down into? Inefficiencies here, and look real close. You see that right there? What is that? What is this little thing right there? I'll give you a second to think about it. What did I tell you ES was going to do? Go higher, right? Up into that gap. That's what these two blue lines are up here. Okay, that real liquidity void, which is the highest portion of that volume imbalance on the weekly chart. So if the market's going to gravitate up to there, we're not looking for shorts, folks. So we wouldn't look at this as a rally up into it to go short. We don't want to see that. So if we can see it go above it and close above it, it does it on this candle here, but we're on a 4-hour chart. So it's definitely going to do a close on an hourly chart or a 15-minute chart, but we're going to just do a top down. This fair value gap would be treated the same way I told you I would want to see the dollar index fair value gap to be an inversion fair value gap. That means that we see it go above it and then treat it as support. Look at the bodies of the candles. That's the narrative. That's the real story is in the bodies. The wicks do the damage. Yes, we wicked through it, but look where it closed. We traded down. Look at the bodies close right there. That's consequent encroachment. That's the midpoint of that gap right there. Here, let me make it nice and obvious. So 41.82 1/4. The open on this is 41.82 1/4. Oh, look at that. Now you're going to tell me, you're going to argue with me, okay? Dollar Menu Mentor, going to tell me that that's buying and selling pressure, that this happened to make that line up exactly right there. Really? Really? I'm sorry. I'm sorry that nobody told you in books before me. I'm sorry that you can't find it on your own. I'm sorry. But you have it now. So stop wrestling with me. You guys, you make arguments against me when I'm telling you something that works phenomenally and how these markets really book price. Inversion fair value gap. If you ever have an inversion fair value gap, and here's for your notes, folks. I was going to save this for the book, but I'll give it here today. If you have an inversion fair value gap like that, and you have a fair value gap that's just below that level inside of your dealing range, meaning you have this low to that high. This inversion fair value gap, we would want to see it trade through that because we're bullish. Buy side, this later on, we don't know that's going to form yet because we're here. It rallies through it. We expect, ICT, tell me how to know when the fair value gaps shouldn't close in. Here's one of those signatures. Inversion fair value gap. All this area should stay open, or a portion of it should stay open. Okay, so in other words, it would look like this. This is what you would anticipate as a fair value gap. Some of you would see this entry in this shaded area here. Some of my students would see this as their multiplier, meaning that they would go long when price dropped into it right there. Other students would see this and say, okay, I want to see it show me proof with the bodies respecting either consequent encroachment or the high of the fair value gap. Is there any body closing at the high? No. We do have a body close right here on this candle at the consequent encroachment. As soon as it does that, we now can trust that this area here should not be traded down into. Technical science, baby. Take notes. Take notes, Goldman Sachs. Okay, because this is the real shit. So this run here goes for what? It takes out the buy side liquidity. Now, folks that just simply watch one of my videos and they see the relative equal highs and relative equal lows that we like to target. We don't look at this as we can trust this as a short, typical retail idea. We want to see something that's going to be at a later time used as a long to go right back there and target those individuals. So this area here would be a buy side liquidity pool. Okay, so that would be a first partial. If a student would use this entry on this fair value gap, they could use this as what specifically? What kind of entry would that be? Right in here, what entry would that be? Institutional order flow entry drill. Meaning that you're only needing it to go to that level or just below it of this fair value gap. Trusting, because we have an inversion fair value gap here, that's going to support price if we get a signature showing that either one of these conditions occur. A body closes at the high or closes at the consequent encroachment. As soon as that happens, the algorithm will immediately spool and go the other direction and aim for delivery to the upside, going after buy side or in an inefficiency above old highs. Buy side's here. Did it look like it wanted to go in a hurry higher? I mean, my chart looks like this. Does yours look like that? It draws to this area here, right in here, and then what do we get? Open, immediate rebalance, bang, hits it. If you get an immediate rebalance, you know where it's going to go. I told you weeks ago that it was going to go up here. It's on YouTube, it's in Twitter, it's all over the place. We were going long. We were focusing on longs, bullish, buying, long. Where to? Right here. Right up here. Immediate rebalance. Even though we took out buy side here, guys out there trying to teach FU candles. There are no FU candles. Okay, that's not my stuff. You want to pretend there's a mythological creature out there called a FU candle? It's your business. But they'll say, okay, look at this. It's running up here. Now it took the stops. Now it's going to sell off. No. How do you know when it's going to take out relative equal highs and reverse, or when it's going to keep continuing? When you have a higher time frame PD array that has yet to be traded to. So I'm not going to look at these equal highs being traded to and then reject and go lower. That's just a partial, and I'm holding on, looking for higher prices and running into higher prices still. Now, what happens if it's trading like this on going into a Friday or Thursday, and we're getting into this area here, but doesn't quite get to the high? It could wait until the next week's Monday, or if it's a holiday, into Tuesday, okay, wherever we open up at. All these things have to be weighed out when you're reading and or trading. It's not just simply get in there and just hold over the weekend, because over the weekend, there's enormous gap risk. Gap risk is the likelihood of a opening that is unfavorable to your position. For instance, say you're long and you're up 80 handles in a position you're holding for ES. it could open up where you're now only up 40 handles. Or in better scenarios, it can open up and now you're up 120 handles right from the opening. And if you get something like that, you should just take your profits there, because it's likely to come in and close in that gap. And you don't know, because you're probably just now learning, you don't know if it's going to fill that gap and continue higher, or close that gap, sputter higher a little bit, and then careen lower even still. So there's lots of things that you have to know. And by the long, drawn out, boring stuff I'm teaching you, I'm giving you all that experience in my dialogue, that you haven't encountered the reason for requiring that or leaning on the necessity of having that information in the beginning. Most of you have no idea. So, and that's why that effect, if you watch my videos multiple times, it feels like you're watching a brand new video when you're paying attention. It sounds like, I didn't hear him say that the first time, when the video is the same one. But now it's more meaningful to you because you're now trading or you're doing back testing, you have more experience, and you're like, oh, that's why he said that. Now I understand it. You can't just watch my videos one time. And I promise you, that is not a reason for you to run my ad revenue up. Okay. I don't care if you watch my videos. I really don't. I only put them up there, and I'm not taking them down when I stop in November. They're there to keep people from wanting to buy it from jokers out there trying to sell it, because they're still trying to. They're on my YouTube channel. Stop trying to fish around for the videos. The videos that you need are those. And I'm teaching you even more. My charter members, the people that pay me, they're in the audience right now learning just like you are. And the things I'm talking about right here, they've never learned that. They've never learned this. This is all fresh right from the oven of ICT, and it's not in your books. So let's go into a 15-minute time frame. I know I'm going to miss you too, but you'll have plenty of things to study when I'm gone. All right, so we have, here's today, Tuesday, Monday. Okay, so Monday was the day we traded up into the high end of that gap on the weekly chart. Okay, the gap is defined by this level as the high and this level as the low. Okay, and all through here, see how we ran up in here? This is all non-farm payroll garbage. This is trashy delivery. Then we rally. See how we fell short of that gap on the weekly chart? It didn't even get to the low of it here. And then careened all the way back down into this down close candle. And then back and forth, opened down one more time. This low right there is consequent encroachment, or just below it, of this wick. Then it rallies strongly up into the low of that weekly gap, and then trades up to consequent encroachment, or midpoint of that range high and low of the weekly gap. So think about it like this. You ever play the game Horseshoes? In the U.S., we have a game that we take two steel posts, little metal poles, and we beat them down into the ground. And we have real horseshoes, and you stand over there, and you got typically two horseshoes a player, and you try to toss the horseshoe and try to get it to ring around that little metal post. Think about your trades and where you're trying to see price go to. Okay, whether or not you get that horseshoe on that post or not is irrelevant. You're aiming for it to go to that post. So you're tossing horseshoes in that vicinity with the expectation that it's going to get a ringer. Okay, a ringer in this case on that gap would be getting to the high, which is what we see it trade to on Friday. But is it a losing trade if you got long and you got out in here and left it thinking that, okay, it might not trade, Friday's afternoon session into that high? It might leave it till the next week. I don't think it would be a losing trade. I don't think it would be a losing trade at all. And if you stick with that narrative, that as long as you're tossing trades in with the expectation that the direction you're aiming your horseshoes or your trades, or you're trying to take partials, you're trying to reach for these levels to get paid at, you don't need a ringer to be profitable. This is the right expression in your equation for success or failure. You think success is only if it goes to the target you called for. That's not true. Success is making money. Success is being profitable. How profitable? You got more money in your pocket than you had last week. You got more money in your account than you had yesterday. That's success. It's modular. Long-term consistency or longevity in trading is long-term profitability. That will absolutely have periods of drawdown where you're losing trades. And that's okay. You limit your risk, cut your position size in half each time you take a loss, and you try to get 50% of the previous loss you got. And once you get that, then you can go back to a little bit higher risk, Going slow in the beginning is important, but keeping the proper perspective in what you're looking for in price action, where is it going, how should you expect price to deliver. I've covered all that today. I covered how price should deliver. I showed you where it was going to go. I told you specifically where it was going to go weeks ago. And we got it here Friday. Now, is it, okay, I'm on a 15. Is it today? Let's go into Thursday, Friday. Okay, so here's current new week opening gap. Very, very small, little, tiny little opening gap. Did it gravitate back to it? Yes. New week opening gaps are like that little post in the game of horseshoes. You don't need it to be a ringer, but everybody in smart money is aiming for that. Okay? We're consolidating, and then we broke lower, trapping traders going short. Why? Because they think it's gone up too long. It has to be going lower. So sell side has been taken. They trap traders short, rallies, small little gap, trades down into a here, but we gravitate back to that new week opening gap. Go back over here. You see this little section of price action here? If this stays open and we take out that low, then we're going lower. Until that, I'm staying bullish on ES. Simple as that. Very simple, right? It's not complicated. It's not, making something bloated with too many moving parts. And we don't need this level. And then you're probably saying, what is that level? To be honest with you, I don't even remember off the top of my head what it is. I don't have my notes next to me. So the low of the gap and the high of the gap here. And new week opening gap. All right, so here's was it Thursday? Friday, right? Friday, post non-farm payroll, we have a gap in here. If we're bullish, are we looking for premium fair value gaps to sell short from? Hopefully you've been watching this live stream close enough to know that that's not what we want. So how do I know when to anticipate a fair value gap to form as an inversion fair value gap? You have to have narrative. Where are you? Are you looking for bullish or bearish? Has the market traded to your higher time frame draw on liquidity? That's this here. That's that gap on the weekly chart. So if we see a gap like this here, right here, everybody else would see that as a return into that. Let's go short and go lower. Now, if we see things like this, that already should tell you no. because this drop down here was this get sell stops taken and either put traders short or take them out of their longs. Then we have a market structure shift here. We have a gap here, and I love seeing gaps that would look like some kind of a, let me change the color here, it's wonky. All right, so we have this gap in here. That gap, when it trades up into it there, if you are just a casual viewer, Netflix and chill type of ICT student, you're going to get tripped up. And you're going to be like the Joker I just blocked on my YouTube channel that was posting stuff saying, this stuff doesn't work. It only works sometimes. This is nonsense. Folks, listen, okay? If you can't make it work, that's where it stops, where you can't make it work. You haven't done enough study to learn it yet. But it's always there. The silver bullet is every day in the times I've told you. And the things I'm teaching with market structure shifts and draws on liquidity, which is the most paramount lesson. That's the thing you need to know. Up in here, halfway point, consequent encroachment between the high and the low of that weekly gap. Think about that analogy I just gave you with the game of horseshoes. Okay. Midpoint is a real good target. Real good target. Best, a perfect ringer would be at the high end. But we're consolidating in here. And we closed on Friday right around here. So we're consolidating at 430. What's the likelihood of it getting up into that high to close that gap in? Very, very low. Very, very, very low. Because we're going into the close and we're going into the Friday close. So they're going to leave that portion open and trade it in Monday and or Tuesday. So you would stay bullish until it hits this level. Then once it happens, you go neutral. You sit still. Not, what do we do next? What do we trade next? You trade sidelines. That wins all the time. You can't lose money on the sidelines. That is a position. Not trading is a position. Not being long, not being short, neutral, on the sidelines, no risk incurred. That is a position. And it always is profitable. It means you have the same amount of money in your account when the day ends that you had when you started. I don't know why it's such a hard thing for people to sit still. They always have to be doing something because day trading is everyday trading to them. And it's not to a professional. It's not. It's absolutely not. So when you see things like this, and you anticipate that a fair value gap would become an inversion fair value gap, meaning we would want to see price trade above, come back down in, and then rally. We want to see that. And if we don't see that, we do nothing. Because the bullish narrative that we're holding, see, in your mind, or in my mind, we fell short of the low of the gap on the weekly chart, which is this level here. And this is where I'm thinking price is going to gravitate towards. It's going to go up there. So all smart money's doing is keeps throwing horseshoes until it gets up in this area here. Every retracement, every discount is an opportunity for a high frequency trading algorithm to go long. What did I just say? Yes. Every single short-term discount, PD array, is utilized by high frequency trading algorithms to go long and then throw their orders into this abyss up in here, in this area up here. Because that inefficiency that the average bear, the average trader, I shouldn't say bear because I'm not saying in deference to bullish or bearish, but the average person, the average trader doesn't think like I'm teaching you. They're not even aware of that volume imbalance. They weren't even looking at that. They're arguing with me. Why are you looking at gaps when the trading during that time that wasn't the front month contract, blah, blah, blah. That's exactly the reason why it works. Wake up. What are you doing arm wrestling me when I'm telling you what works and it happens? Like, I don't agree with this, so therefore let me argue about it. Instead of saying, wow, this shit works. Let me just keep doing what he's showing. That's what I'm trying to convey. But it's like there's a number of you that don't want to learn. You want to argue. You want to debate. I'm not here to fucking debate. I'm here to show you how to make money and get the fuck out of Dodge in November. I'm getting back to enjoying my life. But you're wasting time, all this nonsense of arguing and saying this doesn't work, that doesn't work, because you did 5 examples casually. You got to put yourself in front of these charts and really dig into it. You have to really make an effort to learn this and give yourself permission to know it's going to take you longer than you probably thought. But there are people out there that are absolutely murdering it. Murdering it. They've never made this kind of money in their life before, ever. And they had the same thoughts that you're holding right now. What if I can't do it? What if I can't make this work for me? I've done all this study. What happens if I fail? What happens if you just keep going? Because that's what happened for them. They did the work. They stayed at it. They didn't talk themselves out of it. They didn't let other people on the internet talk them out of it. You roll your sleeves up and say, you know what? This stuff works. It only feels complicated right now because I'm brand new. And now I'm going to sit down. I'm going to be disciplined. I'm going to put myself in there and show myself that I can do this. Okay? The rage right now is the funded accounts, the $150,000 funded accounts. Okay? Trading, let's just say, for instance, let's play devil's advocate for a moment, okay? Let's say, for instance, that you've done the work. You spend the full calendar year doing everything I tell you to do. I mean, think about it. Some of you are in college or you went to college. You submitted to 4 years of bullshit. 90% of the things you learned in college, you don't even use in your career. That's just the truth, okay? I don't care where you are. The fact that you were willing to put that much time into something and probably paid for it, and probably still paying the loan payments that you can't even file bankruptcy for if you go broke, you are having to pay that, whether you're doing that job or not. All that effort and time that you were willing to put yourself through for 4 years with no certainty that you're even going to love what you're going to school for. If you don't love the opportunity that these markets present, don't touch them. Don't trade. Don't learn to trade. Don't do it. If you are not 100% convinced that this is for you, do not touch these markets, period. Don't let anybody entice you into thinking that you can learn their easy black box, this, that, and the other thing. If you're not absolutely convinced that this is for you, do not go any further. Stop. You will save so much pain, misery, probably money. If you're not 100% convinced that this is what you see yourself doing, don't touch it. Because you can't be lukewarm, half-assed, go in here and think, I'm going to try to dabble with it. Dabbling always gets your fingers burned. You're going to lose money. You're going to make money if you stay with it long enough. But it's always going to be a give and take. You're never going to be perfect. You don't have to be perfect. You just need to be profitable. And I teach with a demo account to desensitize yourself about being right or wrong. No other mentor out there stands out there championing the fact that it's demo. But everybody else that sells shit, they have a problem with me because they think that that reduces the efficacy of what it is I do and teach, and my students are making fucking money with it. What would you do if you made $300,000 in the last 3 months? Do you think that you would believe anything anybody else has to say about what you're doing that would be contrary to it? Hell no, you ain't going to give a shit. You ain't going to care what anybody says. Nobody in your family, nobody at your job, nobody that you know, nobody on the internet is ever going to be able to talk you out of what you have now mastered for yourself. And that's a skill set that you carry with you as long as the days are long and you can breathe. And your mental faculties are there. You have that skill set. Nobody can take it from you. Nobody. And you're going to let some Tom, Dick, or Harry on the internet tell you, don't do that. It's a scam. When you're seeing people being interviewed by funded companies, I don't own these fucking companies. I have no affiliation with none of them. And they're all saying that the number one group of traders that are making money at their places are my students. That should be your testimony right there. If you've ever been sitting on the fence and thinking, should I do this? Should I put the effort in? These people are convinced they did the right thing. These funded companies love my students. They love them. Who's next? Who's next? You sit down, you learn this skill set, okay? You learn this skill set, you get comfortable in yourself, you're not recklessly trying to go out and take a trade. One of the questions that came up that wanted me to cover it. How do I know when I can go for a funded account challenge? When should I transition into live fund trading? Minimum expectation and threshold is for you to be completely devoid of any kind of bubbly feeling when you do it right and you made money in your demo or whatever. If you don't feel any kind of emotion, like it's just, I mean, I've been doing this for months. It's the same stuff. I don't feel any attachment to the outcome. I don't care that it was right. I don't care that it would exactly like I expected to. If you're not in a rush to do something every single day, look at the live streamers on YouTube. They're out there pressing all the time. They have to perform like dancing bears. They got to do something for their audience. If you can sit still and say, I don't need to trade right now, and you let the market pan around and it moves a lot and you feel no regret, all the things I just said, and you're consistent in a demo, minimum 6 months. Minimum 6 months. Better traders that have been doing it for a longer time, if they're consistent, like for instance, say you're a profitable trader and you learn from me and now you supercharge your trading. Practice in a demo for 3 months. But if you are not profitable trading in general before coming to me, you have to do at least 6 months in demo. But at the end of that 6 months, you need to be completely desensitized to the outcome. You don't care. You don't care. You don't feel, no, there's no rush that you got to get in there. You're not salivating on Saturday. Can't wait till Monday. That means you're an action hound. You're all hopped up on goofballs because you're gambling. You're not trading. You're gambling. And you just want to have that outcome to make you feel significant again. You don't want to have that. If you're thinking like that or feeling that, do not do a combine challenge. Don't try to do a funded account because you're emotionally charged. You will fail it. And it will set you back. That's mental scar tissue. And it builds into a callus. And eventually you won't want to do this because it's too painful. When all of it is available to you. Every single one of you that are listening to me right now, whether it's recorded and you watched it later on down the road or right here live, you can do this. You absolutely can do it. I'm telling you, you can do this. If I didn't believe it, I wouldn't tell you it. And you're now seeing other people around the world doing extremely well. And I'm so proud. I'm proud to be a small conduit to the bridge where they were and their newfound success. And I'm excited to see where they're going to go. I'm excited to see where you're going to go. But if you're not passionate about this, if you don't absolutely, I mean, listen, I'm not selling you a timeshare, folks. Okay. There's no upsell later on. You're never going to send me any money. And I have more faith in you succeeding than you probably do in yourself. Don't sell yourself short. It's going to take work. It's going to take effort. But let's assume for a moment, let's just say for argument's sake that you did everything I told you to do. And we're at that 6 month threshold. And you've spent time trading and you don't feel like you have to be in front of the charts every single day. You just know what you're looking for. You know your model. You know what you're trying to trade on. And it just happens to be there. And you take those trades. You're at the funded portion. Okay. You don't need any money, like big account size money. And you went the route that the shoestring budget. You can afford the funded account stuff. And you got a $150,000 account. Okay. $150,000 account. You're funded. You're doing the things that I'm teaching you to do. And you're using the logic I'm showing you here. This is Friday. Okay. Inversion fair value gap. Trading and tossing the orders up into this gap, that weekly gap. And then every discount, every short-term discount, what does that mean? What's this level right here? That's 25% level of this range from high to low. These two levels, again, are that weekly gap. So we can throw gradient levels in there. 25, 50, 75. Look at the beautiful reaction there. Look how it hovered around equilibrium. See that? And then closing on the week. Two positions, scaling, long, another longs, partials, partial, and then stopped out. All of this idea of I'm trying to make a lot of money in a short period of time, that needs to go away too. I want to get a better payout than the last guy I saw on the leaderboard of FTML or My Funded Trader or TopStep or whatever. I don't know all the companies. I guess I have no affiliation with none of them. But you're doing this to make money. You're following the logic. You're doing all the things that you're expected to do based on the things I'm teaching you. If you do those types of things and you stick within the narrative that I share with my experience, when I sit down with you either on Twitter or in these videos where I do analysis or I show you where I think it's going to go next. Right now, we're at a point where I'm neutral. I'm neutral. My targets have been met. So I sit still and I let the market then dictate to me what I want to do next because it's already done its quarterly move for me. It might continue higher or it might reverse. At this point, I don't have an opinion that's hardline enough for me to say I'm going to take a trade in this direction. I don't have a target next. And I want you to grow comfortable in those periods because these periods here where everybody blows their account. The folks that go out and say, all right, now what next? What next? They are the ones that will absolutely fail. They're blowing their demo accounts. They will never pass a funded account challenge. They won't hold a funded account challenge in profit, wherever the stage is where whatever you do in the future, you can do a profit split. If they get to that point, they will blow it. They're constantly trying to do something else. They are not comfortable in between trades. They're not. And if that's how you feel, you have to work that out. And these are the periods where I sit still. I'm content. I murdered it on a higher time frame, weekly and daily chart for you. And for the folks that want to see swing trade ideas, where's it going to go on the higher time frames? Well, there you go. Over 1,000 handles in NASDAQ. And however many 100 handles or so in E-mini S&P. What did you do with the information? How did you use it? What are you going to do with it now at the end of this live stream in 5 minutes? And like, oh, I watched this, and he could have said some things in 5 minutes, and I wasted my time. You're never going to be a profitable trader if you're thinking like that. Because I'm telling you, I would have paid money to sit in something like this today. When I first started, I would have gladly spent money for this. Because it wasn't ever in any of the books and courses I bought. It was not there. None of this stuff was out there. None of these things. You're hearing it from the source. These are concepts that were never meant to be in your hands. They were never meant to be understood by the public. That's why they work so good, because it's the market. It's the market. If you had a $150,000 or $100,000 account, so you did the threshold of $100,000, whatever that is, okay, and you did the work of following the logic, doing what is necessary, and you traded when the setups were there, not during non-farm payroll, okay? And I'm answering this too because people say, ICT says, don't trade on non-farm payroll Fridays, and I made this much money, and I made that much money, and blah, blah, blah. No. I say that new students, new traders, new developing minds in these markets should absolutely not trade on non-farm payroll. Nobody should be trading during the hour of non-farm payroll, period. You can, and I've done this before. I've shown you executions and recorded, did the whole thing. I did live sessions. I've done sessions with my private group. Everybody knows I can trade on non-farm payroll. Okay, I don't need to be out here dancing for the people that want me to dance for them. I don't owe you anything. What I'm giving you is the insight on how to do it. So if you want to trade on non-farm payroll Fridays, say you want to, you do the things I just talked about here. You wait. You wait until it gets all the initial volatility in the marketplace. And as long as the objective that you're looking for on a higher time frame chart, the daily, whether it be buy side liquidity or sell side liquidity or a premium fair value gap or a discount fair value gap, they're the only 4 outcomes. And you're saying that's a complication? Really? What do you use to get into a trade right now? that's made you lose money consistently, but you're still holding on to it, thinking it's going to turn into some golden goose for you that lays golden eggs. Because I did all that stuff when I was younger. I did all that same stuff, folks. And I learned by losing lots of money, losing lots of accounts. I've blown dozens of accounts. I've done that, okay? And it took lots of them for me to realize that I was not going to beat it by being tenacious. I had to stop doing all these retail things that I kept buying books and courses with. When I took myself away from all that stuff and said, okay, somebody's winning. Every time I'm losing, somebody is winning. What would they be seeing in price? And that was the start of what I was setting myself up for to be who I am today, Inner Circle Trader. When you have an understanding of that, statistical probabilities state that the average trader, is probably ill-informed. They have no idea what they're doing. And I apologize, my dogs are going crazy. They probably see something outside, like a deer or something. You should have saw Bailey this morning. She was freaking out. We opened her pool up yesterday because it's been really cool in Maryland. Unseasonably cool. But there's 2 toads swimming around in there. I had to fish them out. They kept running to the bottom. And she doesn't like getting baths, but she was really looking like she wanted to jump in there. So anyway, Bella's doing better. Thank you for your concern. But here's an example of if you know what you're doing, you know what you're looking for, and you just want to have one trading opportunity where you work your magic one day and stop. Do nothing else. But you're staying with the ideas that I'm teaching you from a higher time frame basis, using the idea of liquidity and inefficiencies, sticking with the higher time frame bias, only trading in that model, looking for inefficiencies on higher time frame charts where large pools of buying and selling will occur from the aspect of smart money, which isn't in books. The logic that they use to buy and sell. I'm not talking about Goldman Sachs. Okay, Goldman Sachs doesn't know this shit. Okay, they don't know it. The things that you're learning, every high frequency trading algorithm, they implement these ideas. What constitutes a high frequency trading algorithm, buy or sell, isn't on the basis of a pattern. It's not on harmonics. It has nothing to do with anything supply and demand. Has nothing to do with that. There is a draw that price will stay within a buy program. It'll buy as long as this criteria is in play or in existence. And there will be a sell model that they'll only short in when these specific things are met. And there are many chaos high frequency trading algorithms where they trade both directions. All day long, up and down, up and down. That's the part I can't teach you. I can't create a language where I just can't. There you go. I'm just going to leave it at that. I can't. So therefore, what I can teach, I have. And any one of the things I've already taught, and I have more things I'm going to teach between now and November, but any one of these things, these PD arrays, okay, if you apply it with where the market's going to go, where's it likely to go, and you stay with that in that model and you trade around specific times of the day, you can find profitability. And it's not hard. Just silver bullet. There's another model I just gave out, and I told you can use it in every one of the kill zones. London, New York, AM, New York, PM. Every single day you have 3 solid opportunities. Really good opportunities. I taught you how to trade the lunch hour. I mean, think about it, folks. You have so many ways to choose from, but which one makes the most sense to you? Which one can you use? Here's an example right here of using the logic. Your baby, brand new, spanking new, right off the showroom floor. You got your $100,000 account. You're funded now. Okay? Using the logic. There you go. $19,000 one day. Would that be enough? Would that be enough? If half of that was done by you, would that be enough? If 1/10 of this was done, would that be enough for you? I don't know what's going to be enough for you. But many of you look at this as this isn't good enough because you watch somebody else do something. Folks, literally, I could sit down here every single day and roll these accounts up hundreds of thousands of dollars in days. It's no effort for me to do it, okay? But that doesn't communicate a realistic objective for students. Because if I show you these things all the time, you're going to think when you make $5,000 over a month, that's not enough, and you're going to press harder, and you're going to wreck yourself. High reward trading or really big results, that's for people that are trading with the expectation of trying to fleece you to sell you something. I don't need to sell anything to you. I don't want you to buy my books. How's that work for you? I saw a guy tweet to me, ICT is thinking about all the money he's going to make from the book sales. I'm trying to put so much into this YouTube channel that you don't feel inspired to buy a book. How's that work for you? I don't care if it sells a lot. I don't care. I only want it in print because everybody out there that has pretended they found this stuff on their own, there's no fucking way. None of you jokers would have ever learned this stuff by looking at charts or studying it. You never would have learned it because I'm telling you, I was influenced by people you'll never meet. Sorry. And you hear these guys out there, yeah, I figured this out. You didn't figure shit out. You figured out where my YouTube channel was, and you found out where the Telegram channels had my leaked mentorship videos. That's what you figured out. That's the only thing you did. The books will only be there for the purposes of concreting it in history that it came from me, and that's it. That's all. That's the only reason why I'm doing it. But I'm putting so much into these YouTube videos and the content that you really won't need to buy it. You won't need to. So stop listening to the bullshit from other people out there saying, oh, he's trying to get your money. I don't want you to buy the books, period. Don't buy them. Let them be barely profitable for Amazon. Who gives a shit? I don't care. It's just a record of this is what it is. This is what it came from. And this is how you use it. And then when people want to take that book and rewrite it in their own language and create courses, I don't give a fuck. I don't care because it's going to go on forever. It's always going to go on like that. Okay. I don't care. I'm not losing any sleep. I'm not getting poor because of it. Okay. I'm not going to diminish because other people have taken my shit and rebranded it. I don't care. I'm confident that they will now start putting things in people's hands. Even if they do that, it's not classy. It doesn't have any ethics behind it. But people are still going to do it. But I know the end result will be the people that buy it from them won't get hurt because they'll know the real shit. Even if they call it something different. I don't care. But none of this stuff I'm teaching you existed in anything else. And there's $1 million bounty, folks. $1 million of my cash in your fucking hands. I'll drive it to your house. Give you a cashier's check. If you can prove that all the stuff I'm teaching existed anywhere in print prior to 1996. Folks, it just doesn't fucking exist. And that's just the bottom line. Because believe me, $1 million, there's a lot of people out there could use $1 million. And I'm telling you, they all say it. Oh, it's rebranded. Where the fuck did it come from? Where did it come from? Where did I rebrand shit? Nothing. You guys talked and said I rebranded Chris Laurie. I had Chris Laurie come out there on Twitter and say, nope, that's not my shit. Now you're saying Al Brooks. I'm waiting for Al Brooks because he didn't talk about no fair value gap. He didn't teach no inversion fair value gap. He didn't teach as an entry. None of that shit. None of that shit even holds water. I blow holes through all that shit. There's nothing out there like this. And when you understand it, you're going to appreciate that. Because you're holding something that 99.9% of the people out there have no idea even exists. And I've been hiding in plain sight behind a demo account the whole time. Out there hiding in plain sight because it's a demo. Oh, don't listen to that guy. My students are killing it. They're beating the shit out of everybody else's students. They're murdering it. I got people that are doing so well, they don't give a shit about being on social media. What are you going to do when you get the skill set? Are you going to go out there and flex on social media? You're going to go out there and show the trolls? Or are you going to live your life and do what you want to do? Live how you want to live. There's going to be people doubting you all the time. Who gives a shit? Who cares? None of that stuff means anything. If they got the time and interest to do that kind of stuff, that means they're miserable. Leave them there. Leave them in that. You can't fix them. I tried many years. I've tried to do that kind of stuff for people. And I'm at that point, man, I guess it's the 50-year-old kicking in. I just don't get it. Either you subscribe to the ideas because you've seen the efficacy of it and you've seen the background of the logic I'm sharing and how it's in the charts every day. It repeats over and over and over again. But is it for you? Because I'm going to be honest, it's not for everybody. It's not. For some of you, you need a moving average crossover. You need a breakout strategy. And as long as you have good, sound money management, folks, that can make you money. I'm not saying you can't do that. I'm not saying people that trade with VWAP can't be profitable. I watch people on YouTube do it. They do it live. That's no problem. I don't care. But that's grade school level to what's really going on in price. You're not going to get any closer than perfect. I'm sorry, but that's just the way it is. And when I talk like this, it sounds arrogant. It sounds like I'm a conceited prick. I promise you, I know I was one in my 20s. But I'm just talking to you like a friend. I'm trying to intervene because you're holding yourself back. You're holding yourself back. You are the one holding yourself back. It's not me. I've already taught you how to trade. I've already taught you how to read price. I taught you models. I taught you entry strategies and how to take partials and where to move a stop. I've taught you now again why certain imbalances will stay open. How do I know that? Go back and look at the examples when I'm doing it. It's there. But I'm not obligated now, and I wasn't obligated in the past to prove anything to you. I started out this whole thing on baby pips as a social experiment to see if I created the same laboratory conditions that I went through, would I get an ICT? It never happened. I put all the things I taught in the order to I put them out. All the lectures, all the video series, all of them, before I even did paid memberships. All those things, that was the way I came up in that order. From my journals, these are the things that I did where I was spending my attention, and not one person out of this entire community came out looking like me. And that was the reason why I did it. It was a selfish reason. I wanted to see, could I, as a laboratory scientist, mad scientist, try to create the same scenario, and would another ICT pop out? And they didn't. And because I got the feedback from people that they were enjoying the things I was putting out and the understanding they were gaining, the confidence they were getting, I fell in love with the idea of helping more people. Because originally it was just a self-centered just experiment to see if I could create it. And because I wasn't able to do it, I was pissed off. And my obsessive compulsive kicked in. I was like, okay, well, then I'm going to put the work in to try to create one. And then when more people started giving me feedback, it became like a rocket fuel. And I was like, wow, I really like this. I love it. I only would sell my one-on-one mentorship in the 90s. You wouldn't even, you would never, I would have never gone on the internet and shared this stuff then. Never. I would have never done it. I was selfish. And at the time, I then believed if I taught it to everybody, it would fail. Everybody would do it. And then as I learned more and more and more and learned how the markets really book, I don't give a shit. I could literally put commercials on the internet and on the TV that have no sales pitch and say, come to this YouTube channel and learn how to do this shit. I promise you, you won't spend any money, but you'll be better than you ever thought you could as a trader. Stop buying people's courses. It's done. And the channel would grow like crazy. I'd make all kinds of ad revenue. I don't need it. I'm walking away in November 2023. I'm closing the chapter on Inner Circle Trader. I want to be Michael Joe Huddleston. I want to be that. I want to be the husband. I want to be the dad. Hopefully, my kids give me grandkids and I can do whatever I do to spoil them. And that's what I want to do. Everybody wants to know what I'm going to do next. That's what I want to do. I want to be humdrum me again. And that's all I want. But in my absence, I want to be able to look in on all of you and see what you're doing and hear from you. Send me an email. I'm going to keep innercircletrader@gmail.com always. And if you have a testimony you want to share with me, that's great. Do that. Let me know what you're doing. I'm always interested in that. I have a lot of emails. I don't always get to you, in a real timely manner. That's not the mode of contact that is optimal, but Twitter is while I'm on it. But in November, I will no longer tweet, but my Twitter space and my Twitter account will be active, and my YouTube videos will stay up. I just won't be doing any more of them. Okay. I'm confident when I'm done with you all, come November, you will have had the best learning experience from me as a mentor, the best I can do. And I don't claim to be the best mentor. I'm not. I know invariably some of you will do very, very well with this information. And you'll probably write books and you'll probably make courses and you'll probably do whatever and actually teach it better once I'm done divulging what it is I've not made available to people. My only request is you credit me. I don't give a shit what you do with it after that, because if I cared, I wouldn't put it out here. But I want you to give me the opportunity to give God the glory for it. That's what I don't want you to rob me from. I don't care if you make, because I've made millions of dollars for people in the Middle East. I've made millions of dollars for people in Africa that they've sold my shit. Okay, these people have made lots of money selling my videos. Okay, one of my biggest trolls have been selling my videos, but pretends he hates me. His whole channel's around me. Okay, but he sold my shit, and I know, and I don't give a shit. I don't care. He's got kids. Let him feed them. The point is this: I don't care. I don't care. Eat from my table for free. I have plenty. You're not going to starve me. I can do this stuff on my own. And I want to see what you all do with it. And I don't mean, I bought a Lamborghini. That's not what I'm looking for. I want to see what you do with this in terms of helping other people. How are you impacting other people? And I don't mean by teaching people. I'm talking about how you impacted their lives. What did you do for them? Did you buy them a house? Did you pay off their student debt for them? Did you help them out when they needed a car and they just can't afford to get one? Do you support families financially that are destitute and you're not trying to get a reward for it? I promise I will never, ever, ever share that publicly. I will never say, this person told me this, that, because that's your reward then. But I'm asking you. I know I've put people on the rich end with my content, and they rebranded it, made mentorships, and that's how they made their money. That's not what I wanted to do. That's not my target. My target is to transform the lives and the minds and the thought processes of all of you as students, to not just simply listen to me as a mentor about markets, but how to live your life better, because I did not do the right things. And I want you to know that I did not do the right things. I was not there for my wife as much as I should have been. I've failed as a dad. I should have been at their games. I should have done all these things. That's why I give you those lectures. So that way you don't make those same mistakes in the process of finding your success and living in your success, because you can succeed into failure. I did. Lots of money, the ability to live however you want to live and buy stuff, and you have a deficit in the emotional category for fatherhood and husbandry. It's not all about the money, folks. Right now it does feel like that, but there has to be a purpose for all of it, and how you live your life and what you do with it, that's impactful not only to yourself but the people that you're helping. And as a 20-year-old, when I had this information, it was all about me. And I wanted it to be about me. I don't want to be the center of attention. I don't want to be at all. And I hope that you understand that when I do depart in November, I have all of your best interests in mind, and I'm all rooting for you. I'm always rooting for you. I'm constantly in prayer that you all receive what it is I'm trying to convey. And sometimes when I've listened to recordings or whatnot, I wish I could go back in time and add something else. Okay. It would have been much more helpful if I would have said this or that. So, like I said, I'm not the best mentor. And if I don't do it for you come November, don't give up. Don't give up. Keep working towards it. Because if you see just a little bit of evidence that you can do it once in a while, that's okay. Because long term, consistently profitable has a period of hit and miss, break even. If you can get to that point where you're break even, where you make a little bit, but then you lose it, but you don't blow out, that's progress. That's progress. And you'd be surprised how many people come to me in that stage. They've done all this stuff. They make a little bit of money, then they lose it, and they don't blow their account, but they just can't find profitability. You are the best student in my hands. You are the best one. So don't think that that's a reason for you to feel like, I'm failing as I'm doing this because I can't be profitable. I'm not going to waste any more time with this stuff. Come into these lectures and do the things I'm telling you to do, and just sit back and watch the transformation. It'll happen. It will happen. The ones that don't do well under me are the brand new, never learned how to trade, don't know anything, and they have no reason to have that Velcro effect. I can't cling to them, or they can't cling to me long enough to let them have this logic seep into their understanding, and then they see it for themselves. It's too easy for them to walk away. It's too easy because they don't have anything to lean on as experience or reason to see, well, let me stick with this. If I did signals, if I said, I'm buying here, I'm selling here, the only thing that's going to do is grow a dependency in me. And I don't want any of my students to be dependent on me. I want them to be independently minded. So they go out and they do their own thing and they're confident. They say, ICT, it's been great. I learned from you, but I don't need you anymore, babe. I'm going. Watch me fly. And I want to watch you fly. I want to see that. But you have to put some work in, and you got to let the information be presented in the manner that I'm presenting, because I don't know how to do it any better. I don't know how to do it better than I'm doing. But I know it's working for a lot of people. And all you have to do is keep showing up, keep studying, and fall in love with this part of it, because this is what you're going to do the rest of your life. So you might as well love it. You might as well fall in love with it. It's just like your second spouse. Okay? I mean, you're going to have to love doing this. If you're miserable, if you hate trading, this ain't for you. It ain't for you. But if you know that you're going to lose once in a while, but it's okay, nothing changes anything, this means that you got to fix that to go to a new equity high. It's fine. That's the right mindset. And you're not in a hurry to get there. Regardless of how old or young you are, just relax. Let it happen. It took me 6 years to find myself. Many of you probably already have what it is you're going to be trading with, but you're wrestling with it because every time I bring out something new, you want that to be the thing. Oh, wow, that's new. Let me try that. If you already got something you're seeing results with, stay with that. Stay with that. Find some consistency with that. And then once you've done it for a few months, if you want to supplement your understanding, delve into supplementary studies with other things that you are interested in. But you only need one thing. One thing. And you can make all the money you'd ever want. So hopefully you guys have learned something today. I had a lot of fun spending some time with you. If like I said, if you like this stuff and you want to see me do it again on tomorrow and Thursday, I guess it would be. So Wednesday and Thursday, I'm heading out with my wife on Friday for the weekend, and I'll be home on Tuesday. So I won't be doing anything on Monday. So I think that'll be it for this one. Until I talk to you next time. Be safe.